Please like, share, and subscribe. Wishing you happiness and good luck every day.
Welcome to The Explainer. Today we're diving into the absolute classic, The Four Pillars of Investing by William Bernstein. And we're going to try and solve a mystery. How did a humble secretary build a multi-million-dollar fortune while a whole team of Nobel Prize-winning geniuses went completely bust? Well, the answer comes down to four simple, really powerful ideas that can totally change how you think about building wealth. So let's kick things off with this real-life story. It's a tale of two very different investors. On one side, you have a team of certified geniuses. On the other, a secretary nobody really noticed. And what happened to them? Well, it's going to flip what you think you know about success in the market completely on its head.
So, on one side, you've got this hedge fund, long-term capital management, or LTCM for short. It was a true brain trust, packed with the smartest people on Wall Street, including, yes, two Nobel Prize winners. And then, on the other side, you have Sylvia Bloom, a legal secretary who just quietly did her job at the same firm for 67 years, completely off the radar of the financial world.
So these geniuses at LTCM, right? They were so sure about their fancy mathematical models, so confident that they did something kind of crazy. For every single dollar they actually had, they went out and borrowed 25 more. That's called leverage, and it's like putting a rocket engine on your portfolio. It makes your wins bigger, but it makes your losses catastrophic. Now, when you're leveraged up like that, you have zero room for error. All it would take was a tiny 4% dip in their assets. And poof, game over. Complete wipeout. Of course, their super complex models told them this was basically a statistical impossibility. But you know how it goes. The real world doesn't always read the textbooks. And the impossible happened.
Meanwhile, Sylvia Bloom, with just her secretary salary and absolutely no risky leverage, was quietly doing her thing. And when she passed away, people were absolutely floored. She had built a fortune of over $9 million. Her own family had no idea.
And that brings us to the big question, right? How on earth did this happen? What was her secret? How did a secretary build lasting wealth while a team of geniuses with all their advanced theories drove their funds straight into the ground in just 4 years?
Well, Warren Buffett, as he so often does, just hit the nail on the head. He said the guys at LTCM risked everything they did have, their capital, their reputation, to get something they didn't even need, more money. Sylvia Bloom's whole mindset was the opposite. Her goal wasn't to hit a home run. It was just to make sure she never struck out. She was focused on survival. And in investing, survival is everything.
So the secret to her success, and the reason for LTCM's epic failure, it all comes down to this really powerful framework that Bernstein lays out. It's an approach to building a portfolio that can last, and it's built on four key pillars: theory, history, psychology, and the business of investing. All right, so here's the plan. We're going to walk through each of these pillars one by one. We'll start with the basic rules of the game with theory. Then we'll look at the market's crazy mood swings through history. After that, we'll look in the mirror at psychology. And finally, we'll talk about the tricky world of the financial business. Ready? Let's jump into pillar one.
Okay, pillar one. This is like the law of gravity for investing. You just can't escape it. You want to make big returns, you have to take big risks, period. They are two sides of the exact same coin, and anyone who ever tells you otherwise is probably trying to sell you something. This is the simple, unavoidable truth that the guys at LTSM thought they were smart enough to beat.
You know, the famous economist John Maynard Keynes put it perfectly. He said that if you're a serious investor, you have to be able to watch your portfolio tank sometimes and just be okay with it. You have to face those losses with what he called equanimity, basically with total calm. Think of those scary, gut-wrenching downturns as the price you pay to get into the theme park of long-term stock market returns.
So how in the world are you supposed to stay calm when it feels like the sky is falling? Well, here's the secret. You need a pile of safe, even kind of boring assets. Things like U.S. Treasury bonds. They're not exciting, they won't make you rich overnight. But what they do is act like a shock absorber for your portfolio and for your emotions. They give you the stability to hang on when everything else is going crazy. That is the foundation of survival.
Okay, so it's one thing to say you'll accept risk, but it's a whole other thing to actually live through a market crash. And that brings us right to pillar number 2, history. To survive those brutal downturns, you have to get that the market isn't some rational calculator. It's more like a deeply emotional creature, and financial history is our map to its wild mood swings.
The legendary investor Benjamin Graham came up with the perfect way to think about this. He called it Mr. Market. Imagine you have this business partner, Mr. Market. He's a genius, but he's also completely bipolar. Some days he shows up euphoric, shouting about how great everything is, and offers to buy your shares for way more than they're worth. Other days, he's a depressed mess, convinced the world is ending, and offers to sell you his shares for pennies.
Your job, as an investor, isn't to get sucked into his drama. It's to ignore his moods and use his craziness to your advantage. And this is why history is so important. If you've studied the great bubbles and crashes of the past, you've seen this movie before. You know that crazy euphoria is always followed by a painful hangover. And knowing that helps you keep your head when everyone else is losing theirs.
So, understanding Mr. Market's psychology is half the battle. But that brings us to pillar 3. And honestly, this might be the toughest one of all, mastering your own psychology. Because the biggest danger to your money isn't out there in the market. It's staring right back at you from the mirror.
Think about it. Our brains are basically running on Stone Age software. We are wired for immediate survival, fight or flight, following the herd to stay safe, thinking about right now. And that was great for dodging saber-toothed tigers. But those same instincts, they are just absolutely terrible for the kind of patient, long-term thinking that successful investing demands.
And this Stone Age brain of ours leads us straight into all the classic investing traps. We get way too confident and think we can outsmart the market. We follow the herd and pile into hot stocks right at their peak. We trade constantly based on noise and emotion, racking up huge costs. And we gamble on long shots like IPOs. We basically treat the stock market like a Vegas casino. And every single one of those mistakes just eats away at our returns.
All right, this brings us to our fourth and final pillar. And this one requires a little bit of, let's call it healthy skepticism. It's a really important warning. The financial industry, for the most part, is not set up to be your friend.
Okay, this quote is pretty harsh, but it makes a powerful point. It's not that everyone is a crook. It's just that the whole system is often set up as a zero-sum game. Think of it this way. Every single dollar you pay them in high fees and commissions is one less dollar for you. So their goal, to make a living, can be in direct conflict with your goal to grow your wealth. And here's the really scary part. In many cases, there's almost no real educational hurdle to jump over to call yourself a financial advisor. So a lot of the people you might go to for help, well, they haven't really studied the deep theory, the history, or the psychology we've been talking about. They're basically salespeople, which means you and only you have to be your own toughest advocate.
Okay, so let's recap. We've got our 4 pillars, we understand the theory of risk and return, we know the market's history, we've faced our own psychology, and we're wary of the industry. So the big question is, how do we put all this together? How do we use this to build a portfolio that can actually stand the test of time, one that Sylvia Bloom herself would approve of?
Well, it all starts with a huge shift in how you think about investing. You have to stop chasing the highest possible return. That's not the real game. Instead, your number one goal should be to maximize your odds of success. That means building a strategy that's tough enough to survive anything the world throws at it, whether it's a crazy market, your own worst impulses, or the industry's high fees.
And that leaves us with one last really important question you need to ask yourself. Are you building a portfolio to get rich or a portfolio to survive? Are you chasing that shiny rocket ship to the moon like those geniuses at LTCM did? Or are you slowly, patiently, and quietly building a solid foundation, just like Sylvia Bloom? Because the path you choose, well, that's going to make all the difference.
All right, let's get right into it. Today we're tackling a fundamental truth of investing, and the title of this chapter says it all. No balls, no blue chips. Look, the core idea here is really simple, but it's also incredibly important. If you want those big rewards, the high returns from top-tier investments, you just can't be afraid of risk. Understanding that relationship, that's step 1. It's the most crucial step, really. So let's break it down. Okay, so we're starting with this fantastic hook from the source material. It's a bit of a shocker, right? You'd think someone smart enough to be a doctor would just naturally be a great investor. But, and this is the key point, that's exactly the problem. When you mix overconfidence with a serious lack of financial education, you get a recipe for disaster. And hey, this isn't just about doctors. It's really a warning for anyone who's an expert in one thing but a total amateur in another, especially when that other thing is, their entire life savings. And this slide just illustrates the issue perfectly. I mean, think about it. To become a doctor, you need years and years of intense study, practice, and nonstop learning. You have to have this deep, deep understanding of physiology, anatomy, pathology, the list goes on. Now, compare that to how most of us handle our money. It's usually based on a tip from a friend or some headline we saw in the news. The source actually compares it to learning brain surgery by reading the health section of a newspaper. And yeah, when you put it that way, it's pretty obvious why so many smart people make some really bad financial moves. So if we're going to do this right, if we're going to apply some real rigor, where do we even begin? Well, we start with the financial equivalent of physiology, just understanding how the system actually works. And the number one most important rule is this: risk and return are joined at the hip. You absolutely cannot get high returns without taking on significant risk. And that means accepting that you will have losses sometimes. And yeah, sometimes they'll be painful. Safety and high returns, they just don't live in the same neighborhood. This brings us to a really critical term, the risk premium. So what is it? Simply put, it's the extra pay you get for taking a chance. It's the extra slice of pie you demand for sitting at the wobbly table instead of the sturdy one. So if you had a choice between a safe investment that pays a steady 3% and a risky one where a coin flip decides if you get 6% or 0%, you demand to pay less for the risky one, right? That discount effectively boosts your average return if things go well. That extra potential return, that's your risk premium. It's your compensation for the uncertainty. All right, to make this idea really hit home, the source gives us this fantastic thought experiment. Let's imagine you have a mythical Uncle Fred, and he's also your employer. And he has let's call it a very peculiar retirement plan. He's about to offer you a choice that gets right to the heart of risk, return, and all the anxiety that connects them. Okay, here are your choices. Option 1, super simple, super safe. You get a guaranteed 3% return on your nest egg every single year. No stress, no drama. Option 2 is a coin flip. Every year. If it's heads, your account goes up by a massive 30%, but if it's tails, you lose 10%. For 35 years, you have to make this choice. The safe path is totally predictable. The second path, well, that one's going to have you breaking into a cold sweat every New Year's Eve. So what's the catch? Well, after you run all the numbers, that super stressful, risky coin toss option actually delivers an annualized return of 8.17%. Now, you might be thinking, wait a minute, isn't the average of plus 30 and minus 10 just 10%? And you're right, the average return is 10%, but the compound return you actually get to keep, the annualized return, is lower because of all that up and down volatility. It's called variance drag. It's kind of the mathematical price you pay for taking a risk. But here's the thing. Even with that drag, 8.17% is way, way better than a safe 3%. Now, let's take a look at this slide, because it really shows you how all the different outcomes play out over those 35 years. You see that big hump in the middle? That's the most likely result, where you get a good mix of heads and tails, and you end up doing incredibly well. In fact, if you look way over on the far left, the chances of you ending up with less money than the safe 3% option are tiny, less than 5%. So the odds are overwhelmingly in your favor. But that small chance of regret, that's real. And bearing that anxiety, that tiny possibility of failure, that is the price you pay for the much higher expected return. That right there is the risk premium in action. Okay, so we've established that risk and return are linked, but where do these different levels of risk and return actually come from in the real world? Well, it pretty much all boils down to the two fundamental ways a business can get money. You can be a lender or you can be an owner. And that simple distinction creates the two main asset classes we all know, debt and equity. Let's make this super simple with a food cart example. Say you need $10,000 to get started. You could go to a bank and get a loan. That's debt. The bank is lending you the money. Or you could go to your friend Sue, who loves your tacos, and you could offer her a half ownership stake in the business for that 10 grand. That's equity. Sue is now your business partner. She's a part owner. And this chart does a brilliant job of showing the inverse risk relationship here. From the investor's point of view, so the bank or your friend Sue, debt is pretty low risk. The bank has collateral and they get paid back first if your food cart goes belly up. Equity, on the other hand, is high risk. If the business fails, Sue loses her entire investment. But now flip it around. From your perspective as the business owner, the loan is high risk. If you can't make those payments, you're bankrupt. Selling a piece of the business to Sue is lower risk. If it fails, well, you don't owe her anything. See how that works? And that's the key takeaway right there. Because being an owner, an equity investor like your friend Sue, is so much riskier than being a lender like the bank. People who invest in equity demand a higher potential reward for taking on all that extra risk. And that extra potential reward has a name. It's called the equity risk premium. It's the exact same concept we saw with the coin toss, just applied to the real world of stocks and bonds.
All right, let's peel back another layer. We know stocks should have higher returns, but how in the world do we estimate what those returns will actually be? Well, it's tricky because stock returns are really made of two totally different parts. One is a predictable, fundamental part, and the other is a wild, speculative part. The best way to think about it is as the signal and the noise.
So the long-term engine of stock returns, the real workhorse, is what we call the fundamental return. And it's captured by a really simple but powerful formula called the Gordon equation. All it says is that your expected return is just the dividend yield you get from a stock plus the rate at which those dividends are expected to grow over time. That's it. This is the signal. It's the real underlying economic value the company is creating and sharing with you, the owner.
But then you've got the noise. This is the speculative return, and it has absolutely nothing to do with how the business is actually doing. It's all about emotion and perception. It's the change in how much other investors are willing to pay for each dollar of those dividends. This is what's driven by fear, by greed, by market manias, and it is completely unpredictable in the short term. In any given year, this speculative noise can totally drown out that fundamental signal. And this chart just lays it out perfectly. On the left side, we're looking at 10-year periods. See how that black line, the actual return you got, whips wildly all over the place, way above and below the calmer gray forecast line? That is pure noise. But now, look at the chart on the right, which shows 30-year periods. All of a sudden, that same black line is hugging the gray forecast line much, much more closely. Over a generation, that speculative noise just fades away, and the fundamental signal of dividends and growth is what really ends up driving your returns. Now, this is where all this theory gets really personal. We've been talking about risk like it's this abstract concept, but what risk actually means to you depends almost entirely on where you are in your financial life. The exact same market volatility can be a total blessing for one person and an absolute curse for another. Your age, your timeline, it changes everything.
So this leads to a question people ask all the time. And the answer is, well, it's a little more complicated than a simple yes or no. Do stocks really get less risky the longer you hold them? From one point of view, yeah, because that fundamental signal we talked about starts to take over. But from another, more practical point of view, the answer depends entirely on a simple question. Are you putting money in or are you taking money out? Okay, let's dive into this chart because it's fascinating. We've got two savers, Mr. Forward and Mr. Reverse. They both invest the exact same amount of money over 30 years. Now, Mr. Forward gets a terrible market at the beginning, followed by a great one. Mr. Reverse gets the opposite, the great market first. So who do you think ends up with more money? It's Mr. Forward, and it's not even close. Why? Because that early bear market let him buy up shares super cheap when his account was still small. Then the later bull market got to work its magic on a much, much larger pile of assets. For a young person who is saving money, a bear market is an absolute gift. But now, let's completely flip the script. Mr. Forward and Mr. Reverse are now retired, and they're withdrawing a fixed amount of money each year to live on. Mr. Forward, who gets the bad returns first, runs out of money completely in year 26. The early losses, combined with his withdrawals, created a death spiral for his portfolio. Mr. Reverse, on the other hand, who got the good returns first, ends up a multimillionaire. For a retiree, that exact same early bear market is an absolute catastrophe. This terrifying phenomenon actually has a name. It's called sequence of returns risk. It's the critical danger that the order, the sequence in which you experience good and bad returns can have a massive life-altering impact on your portfolio, but specifically when you are withdrawing money. Honestly, it's one of the biggest and most underappreciated risks in all of personal finance. So let's pull all this together. What are the big takeaways here? First, there's no such thing as a free lunch. If you want high returns, you have to accept high risk. Second, those returns basically come from two places, being a lender, which is debt, or being an owner, which is equity. Third, in the short term, markets are just a chaotic mess of speculative noise. But over the long term, that fundamental signal of business value is what wins out. And finally, and maybe this is the most important one, risk is not some absolute number. It is deeply personal and it depends entirely on your financial timeline.
And that really brings us to our final thought. Look, understanding all this theory is one thing, but sooner or later, the market is going to test your discipline with terrifying downturns and crazy euphoric bubbles. It's inevitable. Knowing these principles is your best defense. When that storm hits, what's going to be your anchor? Is it going to be a deep understanding of these fundamentals, or is it going to be the fleeting, powerful emotions of fear and greed? That, right there, is the ultimate question every single investor has to answer for themselves.
Welcome to The Explainer. Today, we're diving into one of the biggest paradoxes in all of investing. And it's this. Why is it that some of the most boring, uncool, and, let's be honest, kind of bad companies have turned out to be some of the absolute best investments you could have ever made? To get us started, just think about this. Let's say Amazon and Caterpillar both walk into a room, and they both ask you for money. One is this world-changing tech behemoth. The other makes, big yellow tractors. Your gut probably tells you which one is the better company, right? But which one has historically been the better investment? The answer is not as obvious as you think. And really, this whole question gets at the heart of a classic Wall Street face-off. On one side, you've got your growth stocks. These are the glamorous, exciting companies with the rock star CEOs that are always in the headlines. And because they're so exciting, investors are willing to pay a really high price for every dollar they earn. And on the other side, you've got value stocks. These are the dowdy, forgotten companies. Think smokestack industries. They're cheap, meaning you pay a low price for their earnings. And this all leads us to what's known as the good company paradox. For decades, the data has shown us something that just feels wrong. The exciting, good companies that we all know and love are often, well, not the best performers. It's actually the boring, overlooked, bad companies that have been quietly making their investors rich. I mean, that's the whole idea right here. It's completely backwards from what you'd expect, isn't it? You'd think a company with a strong brand, with stable earnings, should be a way better investment. But time and time again, the numbers have told a very, very different story. So the big question is, why? What is going on here? So why does this happen? Well, it turns out there's a name for this phenomenon. It's called the value premium. And there are basically three big reasons that explain why these cheaper, dowdier stocks have done so well over time. So let's break them down. The first reason is actually pretty straightforward. Value stocks are just riskier. Yeah, their businesses can be a lot more cyclical, their cash flows aren't always as steady, and a lot of them have more debt on the books. And all that means that when the economy hits a rough patch, they are way more vulnerable. And this slide right here shows you that this risk is no joke. It's very, very real. I mean, look at the Great Depression. Growth stocks got hammered, losing a staggering 81.7%. But value stocks, they got hit even harder, falling over 88%. Or look at the 2008 crisis. Same story. A nearly 63% drop for value. So that extra return that value investors got over the years, it absolutely did not come for free. It was their reward for having the guts to stomach these absolutely brutal losses. All right, reason number 2 has less to do with balance sheets and more to do with, well, us. It's human nature. We just get swept up in a good story. We consistently get way too excited about the glamorous companies, we overestimate how much they're going to grow, and we end up paying a huge premium for that hype. We bid their prices up to levels that are almost impossible to justify. And this chart is the proof. It's from a famous study that actually tracked what these companies earned over time. Now look at that top line. That's the value stocks. Right from day one, because you bought them so cheap, they were already generating almost 4 times more profit for every single dollar you invested compared to the growth stocks on the bottom. And the big question was, would the growth stocks' earnings eventually rocket up and catch up? As you can see, not even close. The reality just never lived up to the hype. And the third reason is all about how the market reacts when there's news. It's totally different for these two groups. So look on the left. When a growth stock disappoints, it gets absolutely punished, lagging the market by a painful 18.5%. But if it beats expectations, the reward is meh, a pretty modest 6.6%. Now look at the value stocks on the right. It's the complete opposite. If they miss their numbers, the market basically shrugs it off. But if they deliver good news, boom, they're rewarded in a huge way, beating the market by a massive 20.1%. So, okay, the case for value investing seems pretty airtight, right? They're riskier, so you get paid more, they're cheap, and the market loves to reward them for good news. But just when we think we've cracked the code, the story takes a massive plot twist. Because for the last decade or so, this super reliable value premium seems to have just vanished. Just look at this chart. This shows you the outperformance of value stocks over growth stocks averaged over 20-year periods.
For decades, that line was consistently positive. You made more money in value. But look at what's happened on the far right of the chart. The line has just plunged off a cliff, even going negative. People have started calling this the lost decade for value investing. And that, of course, leads to the one question that has dominated investing debates for the last 10 years. Is it over? Is value investing finally dead? Have the rules of the game fundamentally changed for good?
Well, there are two competing theories here. On the left, you have theory number one. It says value became what's called a crowded trade. Basically, the secret got out. So many people piled into the strategy that they bid up the prices of all the cheap stocks until, well, they weren't cheap anymore. The premium disappeared. But then you have theory number two on the right, which argues the complete opposite. It says investors have been so mesmerized by big tech that they've been irrationally dumping their boring value stocks, making them cheaper than ever before.
So, which one is it? Crowded and expensive, or abandoned and cheap? Well, this chart is the clue. It's the smoking gun. It shows something called the value spread, which is just the price gap between expensive growth stocks and cheap value stocks. Now, if the crowded trade theory were right, this gap should have gotten smaller, right? But as you can see, the exact opposite happened. The gap has exploded. It's near an all-time high. Value stocks haven't gotten more expensive, they've gotten way, way cheaper compared to growth. And this is the really crucial point. To see a valuation gap this wide is incredibly rare. We've only seen it twice before in modern history. The first time was at the absolute peak of the dot-com bubble, and before that, during the Great Depression. And you know what happened in the years that followed both of those times? Value investing came roaring back and delivered some of its best returns ever. Now, this whole debate, value versus growth, market ups and downs, it's fascinating stuff. But I want you to take a step back with me because what if we've been focused on the wrong kind of risk this whole time? What if the temporary swings in our portfolio aren't the thing that we should really be worried about? Let's think about risk in two different ways. First, there's shallow risk. This is what we usually talk about: bear markets, recessions. They're painful, for sure, but your money eventually recovers. But then there's another kind of risk, a much scarier one, deep risk. And that is the permanent, irreversible loss of your capital, of your purchasing power. This is the risk that can completely derail your long-term financial life. So how do we even begin to protect ourselves from a risk that big? Well, first we have to know what we're looking for. We have to identify its main causes, what our source material calls the four horsemen of ruin. These are the historical forces that have truly caused the permanent destruction of wealth. And here they are, in order from most likely to least likely. Number one is severe inflation, when your money itself just loses its value. Number two is confiscation, when a government takes your assets, either through crazy high taxes or just seizure. Three is devastation, from things like war or revolution that just destroy the economy. And finally, number four is severe deflation, when prices fall persistently, which today is actually the least likely of the four. But of those four horsemen, one really stands out from the pack. It has been the most common and the most dangerous threat to wealth throughout all of human history, and that is inflation. Far more fortunes have been wiped out by inflation than by anything else. For most of us, it's the deep risk we're most likely to face in our lifetimes. If you want to see just how destructive inflation can be, just look at this chart from Germany in the 1920s. The yellow dotted line is monthly inflation. It just goes vertical. Prices inflated by a factor of 1 trillion. Your cash, your bonds, they became worthless paper. But now, look at that solid black line. That's wealth held in stocks. It was a wild ride, no doubt, but because stocks are a claim on real assets, on real factories and real businesses, they actually managed to hold on to their real value. They were a life raft. So what can you do about it? How do you protect yourself? This table gives us a really important clue. It shows how different assets did during the highest inflation years since 1950. Now look at the bottom. The total U.S. stock market actually lost purchasing power. It went backwards. But now look at the top. The stocks of companies that produce commodities, businesses that dig stuff out of the ground like gold, metals, and oil, they actually delivered positive real returns. They can be a potential shield when inflation is running hot. And all of this brings us to our final question for you today. The whole debate between value and growth, at the end of the day, that's really about shallow risk. It's about weathering a temporary storm. But the real long-term challenge is preparing for deep risk, for a permanent change in the financial climate. So the question you should be asking yourself is this: is your portfolio built just to survive the next storm, or is it ready for a fundamental change in the climate itself?
All right, welcome back. Today, we're going to tackle one of the biggest ideas in finance, this whole concept of the stock-picking genius. We're going to pull back the curtain and uncover a really simple truth that explains why most of them fail, and more importantly, what that actually means for you. So let's get right into it. I mean, we all want to believe we can, right? That we can find that one person, that wizard who just sees the future and can make us a ton of money. It's such a compelling idea. But what if that whole game is just an illusion? You see, to really understand the stock market, we're not going to start on Wall Street. No, we're taking a detour to this kind of mythical place, a place whose strange, furry inhabitants have a whole lot to teach us about how money really works.
That's right. We are talking about dart-throwing monkeys. Now, I know, it sounds a little out there, but you gotta stick with me on this because this one weird idea, it's the key that unlocks the entire puzzle of investing.
Okay, so the rules of randomovia are brilliantly simple. First rule, if you have enough monkeys throwing enough darts at a list of stocks, some of them are going to get lucky. I mean, purely by chance, they'll hit a few huge winners, and the media will go crazy calling them geniuses. Second rule, the monkey who was a superstar last year, they have almost zero chance of repeating that performance. Their luck just runs out. And the third rule, this is the big one, as a group, the monkeys can't possibly beat the market average because, well, collectively, they are the market. See where this is going? Welcome to randomovia. It's not so mythical after all. You know, this whole idea didn't just appear out of nowhere. It was like a puzzle that brilliant people solved, piece by piece, over decades. It started way back in 1900 with a guy named Louis Bachelier who figured out that speculation is basically a zero-sum game. Then, in the 30s, Alfred Cowles proved that professional forecasters, well, they couldn't actually forecast. That snowballed into the 60s with Eugene Fama's famous efficient market hypothesis. But the real knockout punch? That came in 1968 when Michael Jensen dropped the first hard, undeniable data on how mutual funds were really doing.
Okay, theory is one thing, but what does the actual evidence tell us? This is where the story gets really, really powerful. Let's dig into the numbers behind this whole idea of a random market. So this slide right here, this reveals the entire magic trick. Look at the chart on the left. This is how fund managers perform before you account for what they charge you. It's a perfect bell curve, right? Centered right on the market average. Some win, some lose. Looks like a fair game. Now, look at the chart on the right. This is what you, the investor, actually get after they take their fees. The entire picture shifts to the left. The number of winners just plummets, and the field of losers explodes. The difference is absolutely staggering, and it's all down to one thing: costs. And this leads to a simple, totally inescapable truth that Nobel Prize winner William Sharpe called the arithmetic of active management. Just think about it for a second. All the professional investors as a group are the market. So before costs, their average return must be the market's return. It's just math. But you, as an investor in one of their funds, you get that market return minus all their fees, their trading costs, their expenses. You are mathematically guaranteed to do worse than average. So you might be thinking, okay, fine, I'll just pick last year's winners. That's got to work, right? Well, the data says very clearly, nope. This chart is amazing. It looks at the top 25% of funds and then tracks how they did in the next 5 years. And just look at this. Over a 25-year period, the ones who were the previous top performers, they actually did the worst. They underperformed the average fund, and they got crushed by just owning the simple S&P 500. Chasing hot performance is literally a ticket to last place. So, if the data is so crystal clear, why are we so obsessed with finding the next investment genius? Well, that brings us to the very powerful and very dangerous myth of the superstar manager. And the reason is simple. We're human. We are wired for good stories, not boring statistics. And the financial media? Oh, they know this. They need those exciting narratives to get your attention. A story about a brilliant manager who's on a hot streak is way more interesting than buy a boring low-cost index fund and get on with your life. So this constant drumbeat of superstar stories creates this really powerful illusion that it's easy to find them. And this quote from Jonathan Clements just nails the trap perfectly. By the time you read about the superstar manager and their amazing returns on the cover of a magazine, the party is almost always over. You end up buying at the absolute peak of the hype, right before that inevitable crash back down to earth. And you know what? There's a real mechanical reason why these superstars almost always flame out.
It's a phenomenon called asset bloat. See, when a manager gets really successful, billions of dollars pour into their fund. But now their trades are so huge that they can't buy or sell a stock without moving its price against them. They're forced to buy higher and sell lower, and these costs just eat away at their returns. Their own success becomes their biggest enemy. It's fascinating. And if you want to see what asset bloat looks like in the real world, here you go. This is the legendary Peter Lynch. In the early days, when his Magellan Fund was small, you can see his massive outperformance against the S&P 500. But then, as the fund just ballooned with new cash, growing into an absolute giant, you can watch his edge, his outperformance, get smaller and smaller and smaller until it basically just disappeared. That is the unavoidable pull of asset bloat. And hey, this isn't ancient history. We just saw a perfect modern example play out with Cathie Wood and her ARK fund. A spectacular rise made her a media sensation, and a flood of investor cash followed. But then, just as the pattern would predict, the fall was just as dramatic. In fact, one study found that because most people bought in late, the average dollar invested in her fund actually lost money and underperformed the market, even with those incredible early years. And this roller coaster ride is the oldest story in the book. Back in the 60s, you had Gerald Ty, the original gunslinger, whose fund spectacularly collapsed under its own weight. Decades later, William Miller beat the market for 15 straight years, an unbelievable feat. But after billions poured in, a couple of bad years wiped out almost all of that historic outperformance for the people who showed up late. The pattern is it's remarkably consistent. So let's get to the objection that I know is on your mind, the one name that seems to break all these rules. But what's so cool is that the greatest exception to the rule actually proves the point. Of course, what about Warren Buffett? His track record with Berkshire Hathaway, it's legendary, it's undeniable. He's clearly not just some lucky monkey. So what does his story really tell us? It tells us that even the greatest investor of all time cannot escape the law of large numbers. Just look at this chart of Berkshire's returns over time. In the early decades, you see that massive outperformance he's famous for. But as Berkshire became one of the biggest companies on the planet, its returns have just steadily drifted down, closer and closer to the market average. The bigger he got, the harder it was to move the needle. And the academics have confirmed this. This table breaks down Buffett's alpha. You can just think of that as the return he got from pure skill. In his early days, his alpha was an incredible 16.65% a year. But look what happens over time as his company got bigger and bigger. In the most recent period, it's down to just over 2%. Even the Oracle of Omaha can't escape gravity. Asset bloat gets everyone in the end. And this reveals the ultimate secret of the investment world. The truly once-in-a-generation talented investors, they are completely inaccessible to you and me. And why is that? Because they don't need your money, and frankly, they don't want it. Okay, so after all of this, the monkeys, the data, the fallen superstars, even Buffett, what does this all mean for you as an investor? Let's boil this all down to a simple, actionable choice. At the end of the day, you have two options. On one hand, you can play the game of chasing stars. It's a game of chance. You pay high fees, you try to find that one manager in 10,000 who has real skill, and you have to find them before they get too big and their luck runs out. Or you can play a game of near certainty. You can just own the entire market through a low-cost index fund, accept the market's return, and because of costs, you are guaranteed to beat the average active investor over time. And here is why owning the market is such a powerful idea. There's some incredible research that shows that over the long run, all of the stock market's returns came from just the top 4% of companies. The other 96%, they basically just treaded water. Trying to find those few golden needles that drive all the returns is nearly impossible. The winning move is to stop looking for the needle and just buy the whole haystack. So let me just leave you with this final thought. Imagine a shell game. You can play, you can try to find the one shell out of 10 that has a $10,000 prize. It's possible, but the odds are stacked against you. Or you can just decline to play and walk away with a guaranteed $8,000 in your pocket. Chasing superstore managers is playing the shell game. Indexing is taking the guaranteed win. So, what's your move?
The quest for the perfect portfolio. We're all on it, right? The one that gives you amazing returns without all the stomach-churning stress. And the advice is always the same. Diversify. Don't put all your eggs in one basket.
But what does that really mean? And more importantly, does it actually work when things get ugly? Well, today, we're going to find out.
So here's our game plan. We're going to kick things off with a simple coin toss to see the magic of diversification in action. Then we're going to poke a huge hole in how most people, even academics, think about risk. After that, we'll get into something called the correlation game. And then we'll stress test all these ideas against a true lost decade for the stock market. And finally, we'll put it all together to figure out what a truly resilient portfolio actually looks like.
All right, let's dive right in. And you don't need a PhD in finance to get this first part. To really get a feel for the power of diversification, all we need is a quick story about your generous and maybe slightly eccentric Uncle Fred.
Okay, so picture this. Your bonus is on the line with a single coin toss. Heads, you get a sweet 30% gain. Tails, you take a 10% loss. That's a straight 50-50 shot at losing money. Not great. But then, your uncle makes a new offer. He'll split the bonus in two and flip a separate coin for each half. Now, suddenly the game changes. You could get 2 heads, still a 30% gain, or 2 tails, still a 10% loss. But you could also get one of each, which works out to a 10% gain. And just like that, your chance of losing any money at all drops from 50% all the way down to just 25%.
Now, here's the part that's kind of crazy. It's not just that our risk went down. Get this. Our expected return actually went up. Yeah, the math shows that by moving from one coin to 2, the annualized return actually jumps from about 8.2% to over 9%. So, lower risk and a higher return? I mean, that's the dream, right? That is the seductive promise of diversification.
All right, so there's a fancy finance term for what we just saw. It's called standard deviation. Just think of it as a wobble factor. The bigger the wobble in your portfolio, the higher the risk. In our little game, the single coin toss had a wobble factor of 20%, but with 2 coins, it dropped all the way to 14%. And the textbook thinking is simple. Lower wobble equals safer investment. But, and this is a big but, it's not nearly that simple in the real world.
And that brings us to the first major twist in our story. Because it turns out that this clean, neat, academic definition of risk, this standard deviation thing, well, it has a massive blind spot. One that can be incredibly dangerous if you don't know it's there. So here's the problem. Standard deviation treats every drop the same. It makes no distinction between, say, a 5% dip on a quiet Tuesday in July and a 5% drop when it feels like the entire global financial system is about to implode. But for you, for me, for any human being, those two events feel completely different. Let's be honest, bad returns hurt a whole lot more when times are already bad. Let me show you exactly what I mean. Take a look at this. We're comparing 2 totally different portfolios over almost 50 years. On one hand, you've got a portfolio that's 100% in corporate bonds. On the other, a mix of 90% U.S. Treasury bonds and 10% stocks. And on paper, they look like twins. I mean, they had the exact same wobble factor, that seems standard deviation, and nearly identical returns. So according to the textbooks, they were equally risky.
But then, 2008 happened. Let's zoom in on the heart of the financial crisis. In just 2 months, that corporate bond portfolio got hammered, losing over 8%. And the Treasury of stock mix, it was barely scratched, down just 1.4%. Let that sink in. Same risk on paper, a totally different story in a 5-alarm fire. One shattered your nerves, the other was a port in the storm.
And if you want to get a sense of the absolute fear in the air back then, just listen to this. That's what a U.S. Senator told his wife after getting a crisis briefing from the heads of the Treasury and the Federal Reserve. He literally thought the ATMs were about to stop working. That's the kind of raw, gut-wrenching fear that a simple number on a spreadsheet just can't begin to capture. So what's the big lesson here? It's that risk isn't just a number. It's not just volatility. True risk is all about how your investments behave when you are most terrified. See, corporate bonds are basically loans to companies, so in a panic, they started acting a lot like stocks. But treasuries, backed by the full faith and credit of the U.S. government, that was the one thing people still trusted. And that difference is everything.
Okay, so if the wobble factor isn't the whole story, what else do we need? Well, this brings us to a slightly more advanced tool that investors use in their quest for the perfect portfolio. And it's all about something called correlation. Now, don't let the fancy name scare you. A correlation coefficient is just a simple score that goes from -1 to +1. If two things have a correlation of +1, they move in perfect lockstep. If it's -1, they're perfect opposites. And if it's 0, well, remember our two coin tosses? Their movements were totally independent. That's a correlation of 0. And for diversification, that's the holy grail, finding things with low or even negative correlation.
And check this out. Here's how it works in the real world. This chart shows stocks, real estate investment trusts, or REITs, which are just companies that own buildings, and a 50-50 mix of the two. Now just look at that thick black line, which is the mix. It actually produced a higher return with less of a wobble than either stocks or real estate did on their own. That, right there, is the magic of low correlation in action. Okay, so this seems pretty simple, right? Just find a bunch of things that don't move together, mix them up, and you're golden. But here comes twist number 2. What happens if those correlation numbers we're relying on aren't actually stable?
This chart just perfectly illustrates the danger. For decades, the advice was, buy international stocks, diversify globally. But just look at what's happened over time. As the world's economies got more and more connected, the correlation between U.S. and international stocks has just climbed and climbed. And here's the kicker. They tend to move together most during a panic, which is the one time you desperately need them to go their separate ways. So this leads to the question that probably keeps a lot of investors up at night. If everything just crashes at the same time anyway, is there even a point to diversifying? It's a great question. So let's put it to the ultimate test and look at the evidence from one of the absolute toughest periods in modern history.
Okay, this table tells such a powerful story. First, I want you to just focus on those first two columns. That's the dot-com bust and the 2008 financial crisis. And yeah, at first glance, it confirms our worst fears. During the 2008 crisis, pretty much everything got crushed. REITs, emerging markets, smaller U.S. stocks, it didn't matter. It really felt like there was nowhere to hide. In the middle of the fire, diversification seemed to fail.
But wait, now look at that last column on the right. This shows the returns for the entire decade, from 2000 to the end of 2009. The S&P 500, it actually lost money over 10 years. But those other assets, look at them. Small-cap value stocks were up over 120%. REITs, even after that massive crash, were up 170%. This is so important. Spreading your bets might not save you from the short, sharp pain of a crash, but man, does it prove its worth over the long haul.
So, where does all of this leave us? Well, it all points to a new, and I think much more powerful way of thinking about what a perfect portfolio really is. It's not about finding some mathematically optimal mix that looks good on a spreadsheet. It's about building a portfolio that's designed to help you survive your own behavior when a storm hits.
You know, the legendary investor Charlie Munger absolutely nailed it with this one. The real secret sauce of building wealth is just letting the magic of compounding do its thing over a very, very long time. And what's the single biggest threat to that? Interrupting it, selling at the absolute worst moment, usually because of fear.
And this is really the whole point of our journey today. The reason to own those boring, safe assets like treasury bonds, it's not really about the return they generate. It's about psychology. They are the anchor in your portfolio that gives you the courage and the financial stability to hold on to your stocks when they're down 50%. It's what stops you from making that one catastrophic mistake. So how much of this safe stuff is enough? Well, there's no single magic number, but it's pretty telling that Warren Buffett, arguably the greatest investor ever, usually keeps about 20% of his company's assets in cash and U.S. Treasury bills. He calls it a fortress, something that prepares him for both crisis and opportunity. And you know, that's probably not a bad rule of thumb to think about.
So I'll leave you with this one question to think about for yourself. When you look at your own investments, is your portfolio designed to chase the highest possible number on a chart during the good times, or is it built with enough resilience to make sure you can actually stay in the game and survive the bad times? Because the answer to that question, well, that could make all the difference.
You know, what if I told you that the decades-long Nobel Prize-winning search for the perfect investment portfolio was, well, pretty much a wild goose chase? Today, we're diving deep into asset allocation, and we're going to uncover a simple truth that is way more powerful than any complex formula you can imagine.
So let's just start with the big one, right? Is there some secret recipe, some kind of magic formula out there that can just hand you the best possible returns for whatever risk you're willing to take? I mean, it's the holy grail of investing, and that is exactly what we are on the hunt for today.
All right, so here's the game plan. We're going to start by chasing this myth of the perfect portfolio. Then we'll actually visualize why it's so darn tricky. After that, we'll uncover a so-called magic formula, expose its fatal flaw, and then we'll land on a piece of wisdom so simple and so profound, it comes from the last person you'd ever expect. Okay, let's kick things off in the land of investing myths. You know, most of us who've been around the block know there's no stock-picking fairy who can magically beat the market every time. And a market timing fairy? Yeah, right, pure fiction. But what about an asset allocation fairy? Is there one of those? The hard truth? Nope, there isn't. There's no guru, there's no supercomputer, there is no secret technique that can just conjure up the perfect mix of assets for your future. And that's a really important point. We have to stop looking for one. So, if there's no fairy godmother for our portfolios, how do we even begin to wrap our heads around this? Well, let's try to visualize it. We'll start simple. In a world where you only have two things to choose from. See, if you're only choosing between, say, US stocks and treasury bonds, all your possible options land on this one beautiful, clean curve. You just have to figure out how much risk you're comfortable with, find your spot on the line, and bam, you're done. It looks almost too easy, doesn't it? But we all know the real world isn't that simple, is it? We've got tons of options. So what do you think happens to our nice, neat little curve when we start throwing more ingredients into the portfolio stew? Well, let's check out an experiment that does exactly that. It takes 6 totally different, risky asset classes. We're talking everything from the S&P 500 and US small caps to European stocks, Japanese stocks, and even precious metal stocks. And it just mashes them all together in hundreds of different combinations. And this is what you get. It's not a line anymore, not even close. It's this chaotic cloud of dots. The author of the source material calls it a porcupine. Every single one of those dots is a different portfolio. All of a sudden, trying to find the best one feels totally impossible, like finding a needle in a haystack. But wait, look closer. There is a method to the madness. See that upper left edge of the cloud, the part that kind of looks like the porcupine spine? That is called the efficient frontier. Those are the optimal portfolios, the ones that give you the most bang for your buck, the absolute highest return for any given level of risk. The whole goal then is to somehow land your portfolio on that spine. Okay, so the big question is, how do we find that spine? How do we get on the efficient frontier? Well, for decades, the world of finance was convinced it had the answer, a kind of mathematical magic formula to solve this very problem. Let's rewind the clock to 1952. A brilliant PhD student named Harry Markowitz comes up with this groundbreaking technique. It's called mean variance optimization, or MVO for short, and its purpose was crystal clear. Use math to figure out the exact mix of assets that would land you on that coveted, efficient frontier. And on the surface, it seems pretty straightforward. You only need 3 things: your best guess for future returns, the risk level of each asset, and how they all move in relation to each other. You just feed those numbers into the MVO black box, press a button, and boom, out pops the perfect portfolio. Sounds amazing, right? Almost too good to be true. Well, you probably know what's coming next. Here's the twist. This elegant, Nobel Prize-winning piece of mathematics has a huge, huge practical problem when you try to use it in the messy, real world. The magic, as it turns out, is a bit of an illusion. Yeah, MVO has 2 fatal flaws. First, it is ridiculously sensitive. I mean, you can tweak your forecast for one asset class by a tiny fraction of a percent, and the optimizer will just freak out, telling you to dump everything into one asset. But the second problem is even bigger. It's all about chasing the past. It's like driving a car by looking only in the rearview mirror. It loads you up on whatever has been hot recently, which, thanks to something called mean reversion, are often the very assets that are about to cool off. This is such a well-known problem that people in the industry have a nickname for it, and it's not a flattering one. They don't call it a mean variance optimizer. They call it an error maximizer, because it takes your small, unavoidable mistakes about the future and just blows them up into potentially catastrophic portfolio decisions. So, if the fancy math is a dead end, where do we go from here? Let's just put the formulas aside for a second and search for a simpler, more powerful kind of wisdom. And who better to ask than the guy who invented the flawed formula in the first place? And this, my friends, is where the story gets really interesting. A financial journalist named Jason Zweig once had the chance to ask Harry Markowitz, the father of mean variance optimization, how he actually invested his own retirement money. Did he fire up his own complex Nobel-winning algorithm? He didn't use it, not at all. Markowitz said he thought about how much regret he'd feel if the market went on a tear and he wasn't in it, and how much regret he'd feel if it crashed and he lost a ton of money. You see, his goal wasn't to optimize returns. It was to minimize future regret. So what did he do? He just split his money 50-50 between stocks and bonds. The creator of the ultimate financial black box used a simple rule of thumb driven by human emotion. How incredible is that? The source material draws this amazing parallel to a famous story about the ancient rabbi Hillel. A guy challenged him to explain the entire Torah, the core of Jewish law, while standing on one leg. And Hillel didn't recite a bunch of complex rules. He just gave one simple, profound principle about empathy, and then said, "The rest is commentary." And that right there is the true wisdom of asset allocation. The single most important decision you will ever make as an investor is your basic split between stocks and bonds. That is your financial Torah. Everything else, which specific brand of international fund to buy, whether to add a sprinkle of small cap value, all of that is just commentary. So let's wrap this all up. First, stop looking for a magic formula or an asset allocation fairy. They don't exist. The most crucial thing you can do is look inside yourself and figure out how much risk, how much potential regret you can actually live with. That feeling is what should determine your big picture split between stocks and bonds. Once you nail that down, I promise the rest gets a whole lot easier to manage. And that leaves us with the final and most important question, the same one Harry Markowitz asked himself. Stop chasing the myth of the optimal portfolio. Instead, ask yourself, what future regret will you choose to minimize? Is it the pain of missing a huge rally, or is it the pain of watching your portfolio get crushed in a downturn? The answer to that question, that is the true key to your personal asset allocation.
You know how people change as they get older, right? We crawl, then we walk, then maybe, eventually, we need a cane. But what if your investment strategy needs to change just as dramatically over your lifetime? Well, that's exactly what we're digging into today, the 3 distinct ages of your financial life, where each one has its own set of rules, its own risks, and its own unique strategy for success.
So here's the game plan. We're going to start by framing this whole journey with a really cool ancient riddle. Then we'll jump right into the big paradox that every young investor faces. From there, we'll tackle the single biggest risk in retirement and lay out a clear plan for security. After that, we navigate that really tricky pre-retirement decade, and we'll wrap it all up by looking at the, frankly, unfair lottery of market timing.
All right, to really get a handle on an investor's life cycle, we're going to start with a classic, a true classic, the riddle of the Sphinx. Trust me, it's the perfect metaphor for the journey we're about to take.
Think about this for a second. This riddle has been stumping people for centuries. It's so simple, but it's also incredibly profound, and it's all about the stages of life. 4 legs, then 2, then 3. What could it possibly be?
The answer, of course, is man. Crawling on all fours as a baby, walking on 2 legs as an adult, and then using a cane, a 3rd leg, in old age. And just like that, investors have 3 ages too. We're going to explore the beginning and the end first, and we'll save those tricky middle years for a little later.
Let's kick things off in the morning of our financial lives, when we're young. And right away, we run into this fascinating conflict between what all the academic theories say we should do and what our messy, emotional human nature actually lets us do.
Okay, so the core idea here is something called human capital. Just think about it. When you're young, all of your future lifetime earnings, all those paychecks stretching out for decades, they represent this massive asset, potentially worth millions of dollars. Academics look at that stream of future cash and they say, hey, that's like owning a giant, super stable bond.
Now this is where things get really interesting, because you see this huge clash. On one side, you've got the academic ideal. The theory says since your human capital is basically a giant bond, you should be totally all in on stocks, maybe even using leverage to get like 200% exposure. But then there's reality. We aren't theoretical spherical cows in a physics problem. We are real people, and we're hardwired by evolution to hate losing things. A huge loss early on can literally scar you for life and scare you away from investing for good.
And this just hits the nail on the head. The financial humorist Fred Schwed said it perfectly almost 100 years ago. You can talk about market downturns all day long, but absolutely nothing prepares you for that gut punch feeling of seeing a huge chunk of your own money you worked hard for, just disappear. Financial theory just doesn't have a column for that feeling.
Okay,
Now, let's fast forward. We're jumping to the evening of an investor's life, retirement. And here, the biggest threat you face isn't a market crash itself. No, it's the timing of that crash. It's a danger that so many people just don't see coming until it's way too late.
This danger has a name. It's called sequence of return risk. And here's why it is so incredibly terrifying. If you get a big market downturn while you're still working and saving money, hey, it's a bargain. You can buy more stocks on the Jeep and you'll recover. But if that exact same downturn happens right after you retire and you start withdrawing money to live on, well, now you're forced to sell more of your investments at rock bottom prices, and that can permanently cripple your portfolio's ability to ever bounce back.
Just look at these charts. They show the devastating impact of this sequence risk. On the left, using historical data, you see most retirees did okay. But see that line for the person who retired in 1966? They ran out of money in about 30 years because they got hit with a terrible sequence of returns right at the start. Now look at the chart on the right, which uses more realistic future projections. At the same withdrawal rate, several of those retirees go broke, and that poor 1966 retiree's portfolio gets wiped out even faster. That right there is the brutal power of sequence risk.
And this brings us to that famous 4% rule you've probably heard about. Here's the problem. That rule was based on historical returns from a time that's, well, it's probably not coming back. With lower expected returns for the future, that old rule is now deep in the danger zone. For a much safer retirement, a lot of experts are now saying that 3% is the new 4%.
Okay, so we've identified the risk. It says scary one for sure. But here's the good news. There's a really straightforward and powerful way to manage it. It's all about creating this mental framework for your money with two totally separate buckets. The whole key here is this two-bucket approach. Your first bucket is your liability matching portfolio, or LMP. This is your don't go broke bucket. It's filled with super safe assets like inflation-protected bonds, and its only job is to cover your essential living costs. Once that's full and secure, everything else, every single dollar, goes into bucket number 2, the risk portfolio, or RP. This is your legacy and luxury bucket. This is for growth, for fun stuff, and for your heirs. It's such a powerful psychological hack.
So how do you actually do this? Well, it's a pretty straightforward 3-step plan. Step 1, maximize your annuity. And the best one most of us have is Social Security, so defer taking it until age 70. That gives you the biggest guaranteed inflation-adjusted income for life. Step 2, build your safe bucket, your LMP, using something called a TIPS ladder. That's just a portfolio of inflation-protected bonds that mature at different times to cover the rest of your living expenses. And then, step 3, with all your essential needs totally covered for life, you invest everything else in your risk portfolio for growth.
So you've got this clear 3-step plan for a secure retirement. It sounds simple enough, right? But this brings us to the afternoon of our investor's life. And honestly, it's arguably the most difficult part of the entire journey, that tricky decade right before you retire. This is where you have to decide when exactly to stop playing the game and pull the trigger on that plan.
I mean, this is the question that keeps pre-retirees staring at the ceiling at 3 a.m. After a lifetime of taking risks to grow your nest egg, when do you finally declare victory? When do you take your chips off the table and switch from playing offense to playing defense? It is an unbelievably difficult decision, and the consequences are absolutely massive.
Well, here's a simple rule of thumb to help you out. First, calculate your liability matching portfolio. That's the amount you need in safe assets to cover about 25 years of your essential spending. Once your total portfolio hits that magic number, you've won. You've done it. It doesn't matter if the market keeps screaming higher, you have secured your retirement. It's time to take the risk off the table and shift to safety.
All right, for our last section, let's zoom all the way out. Because an individual's success isn't just about their own smart choices or their discipline. There's this massive element of pure luck involved. Specifically, the luck of when you were born and when you started putting money away.
Now this chart is just incredible. It brilliantly illustrates the fundamental unfairness of investing. It shows how many years it took people to save for retirement based on the year they started working. And the swings are just wild. The year you start your career can literally add or subtract decades from your working life. See those sharp waterfalls? That's where a market peak hits, letting one group of people retire while the very next group has to wait another 10 or 15 years.
Let's just boil all that crazy data down to a simple comparison. An investor who started saving in 1949, right at the beginning of a long bull market, took 37 years to reach their retirement goal. But someone starting in 1980, near the start of a bear market, got there in just 19 years, almost twice as fast. It's a total paradox, but it's actually much better to start your saving career when markets are down in the dumps.
So what's the big takeaway here? It's that your success isn't just about discipline and how much you save. A huge part of your final outcome is determined by pure chance, by what the market happens to do during your specific working years. The source material calls this demographic roulette, and it's a really sobering reality for every single long-term investor.
And honestly, this quote just wraps up the entire philosophy, especially for those later stages of your investing life. The goal isn't to get as rich as humanly possible. The goal is to not die poor. It is always, always better to err on the side of caution and end up with a slightly less luxurious retirement than it is to take too much risk and suffer a catastrophic loss you can never recover from.
So we'll end on this thought. We know the markets are unpredictable. We know there's a huge element of luck in when you start your journey. In a world of so much uncertainty, a world of demographic roulette, maybe the single most powerful tool you have, the only bet where the odds are truly stacked in your favor, is to focus relentlessly on the one thing you can actually control, your own savings rate.
Okay, so you've done the hard part. You're saving money, you're investing regularly, awesome. But what's the next step? Well, the single biggest decision you're going to make from here on out is your asset allocation. Today, we're diving into how you can build a portfolio that's actually right for you. Let's get to it.
These are the big questions, right? What stocks, what bonds, how much of each? It can feel like a lot, I get it. But don't worry, we're going to break this down into a really clear, manageable way of thinking about it. The goal here isn't just to find an answer, it's to find your answer.
You know, it's funny, designing a portfolio is a lot like planning a meal. You have to figure out what kind of person you are first. Are you a meat and potatoes investor? You just want something simple, something effective so you can get on with your life? Or are you a portfolio gourmet, someone who actually enjoys digging into the details, obsessing over every little ingredient? There's no right or wrong answer here, but knowing which one you are, that is the crucial first step.
So here's our game plan. We'll start by figuring out your investor personality. Then we'll build the foundation of your portfolio with stocks. After that, we'll talk about adding a little spice with something called tilts. Then we'll cover your safety net, and finally, we'll put it all together with some sample portfolios. And we'll wrap up with what is, hands down, the most important rule of all.
Okay, let's get into it. Every portfolio needs a growth engine. For pretty much all of us, that means stocks. This is the main course of our meal. And the most logical, unbiased place to start is with, well, the entire world's stock market.
So, if you could just buy a little piece of every public company on the planet, what would that look like? Well, right now, the global market is split roughly 61% in U.S. stocks and 39% in stocks from other countries. For an American investor, this is the perfect, neutral starting point. Think of it as the default setting before we start making any personal adjustments.
But you might want to tweak that 39% number. On the one hand, all your bills are in US dollars, right? So holding a ton of foreign stocks adds currency risk. Plus, there can be some minor tax annoyances. But on the other hand, foreign stocks right now are generally cheaper, which means they have higher expected returns going forward. So what's the takeaway? A range anywhere from, say, 30% to 50% in foreign stocks is totally reasonable.
Okay, now we get to the really fun part, especially for you portfolio gourmets out there. We can start adding some spice. This just means we're going to intentionally move away from owning companies just based on their size, and instead, we're going to bet on certain characteristics to try and juice our long-term returns.
The fancy term for this is factor tilting. All it means is you're tilting or overweighting your portfolio towards stocks that have certain traits. The two most famous ones are being small, so small cap stocks, and being cheap, what we call value stocks. The hope, the bet, is that by taking on this specific type of risk, you'll earn a higher return over the long, long haul.
But let's be absolutely clear about this. It is a bet. Yeah, the history's on your side, and yeah, these stocks are pretty cheap right now, but you have to look at the other side of this coin. You have to be ready for the very real possibility of underperforming the market for decades. Not years, decades. These stocks can get absolutely crushed in a market panic. You need nerves of steel to stick with this.
Beyond small in value, there are a few other spices you can sprinkle in very small amounts. You've got REITs, which are basically just bundles of real estate. You've got energy stocks, which can help protect you against inflation. And then you have precious metals equity, which is super volatile. It can do well when the world feels like it's falling apart, but honestly, it's really only for the most die-hard asset allocation nerds out there. All right, we've built the engine, we've added our spices, but now we need to talk about the brakes.
the part of the portfolio that keeps you safe. We need to talk about your safety net. We need to talk about bonds.
I just love this description. Bonds are so much more than just a boring asset class. They're your lifeboat when the stock market is sinking. They're your sleeping draft, the thing that lets you sleep at night because you know not everything is on fire. And, maybe most importantly, they are your option on the future. That's your dry powder, the cash you use to buy stocks when everyone else is panicking and everything's on sale.
So, which bonds should you own? The advice here is really, really clear. Keep it simple and keep it safe. Stay away from corporate bonds. Why? Because in a true crisis, they start acting a lot like stocks. People get scared the company will go bankrupt. Also, avoid long-term bonds. As we all saw back in 2022, when interest rates go up, long-term bonds can get absolutely hammered. So, where does that leave us? Stick to the boring stuff. Short-term U.S. Treasuries, CDs, that's your safe harbor.
Okay, let's put this all together. It's time to plate the meal. We're going to look at a few different sample portfolios, from the absolute simplest to something a little more complex for all you gourmets.
So the easiest option, the set it and forget it choice, is a target date fund. You just pick the fund with the year closest to when you think you'll retire, and that's it. It does everything for you. You can see here how a fund for a young person is about 90% in stocks, and then as you get closer to that target date, it automatically, gradually gets more conservative. One fund, and you're done.
But, and this is a big but, that one-size-fits-all approach has some real trade-offs. For a young investor, 90% in stocks might be way too aggressive, leading them to sell at the worst possible time. On the flip side, for a retiree, it might still be too risky. Plus, if you look under the hood, their bond holdings often include the exact corporate and long-term bonds we just said to avoid.
So is there a simple alternative that's maybe a little bit better? Yep, you could build something like the Global Couch Potato Portfolio. It's just two funds, one that owns the entire world stock market and another that owns super safe short-term government bonds. You pick the split that works for you. Maybe it's 50-50, maybe 70-30, and that's it. It gets rid of all the problems of a target date fund with almost no extra work. And for those of you who want to be the chef, who want more control, you can climb this ladder of complexity. You can start with just one world stock fund, or you can split that into US and international, or you can break that down even more into developed and emerging markets. Then you can add your little spices like REITs, and finally you can carve out a piece for your small cap value tilts. This shows you how you can build from super simple to super complex, piece by piece.
Okay, we have covered a ton of ground on what to own and how much to own, but I'm telling you, none of it matters, not a single bit of it, without this final, most important rule. This is the secret ingredient that makes the entire recipe work. Just let that sink in for a second. A suboptimal allocation you can execute is better than an optimal one you can't. What that means is the smartest, most perfectly engineered portfolio on paper is completely worthless if you get scared and ditch it during a crisis. The best portfolio for you is the one you can actually stick with through thick and thin, no matter what.
So why is sticking with the plan so hard? Because from time to time, markets go completely barking mad. You're going to live through wild manias like the dot-com bubble or the crypto craze, and you're going to live through terrifying panics. And it's in those extreme moments that your discipline is tested and when most people throw their perfectly good plans right out the window.
So how do you prepare for that madness? By studying history. Financial history is basically a collection of accident reports. You read them so you can learn from other people's mistakes, because trust me, you are not going to live long enough to make them all yourself. Understanding what's happened before is what gives you the courage to stay the course when everyone else is losing their minds.
And so we'll leave you with this final thought. You can design the perfect portfolio. You can pick all the right funds and all the right amounts. But the real question, the one you have to be really honest with yourself about, is how much of your discipline is actually going to survive a real market panic. Answering that question for yourself, that's the real key to success.
Welcome to The Explainer. You know, if you've ever looked at your savings account and just sighed, wondering, why is this barely growing? Trust me, you are not alone. Today, we're going to go on a pretty epic journey through financial history to figure out the real reason your money doesn't grow like it used to. And here's the twist, why that might actually be a good thing. It's the big puzzle of modern finance, isn't it? You do everything you're supposed to do, you save, you invest, but the returns just feel, well, frustratingly low. From savings accounts to the long-term outlook for stocks, it really feels like the era of high, easy returns has just vanished. So what is really going on here? Now, you might think the answer has something to do with the Fed's latest policy or, market trends from the last decade. But the real story? Oh, it is so much bigger than that. The reason your savings account earns next to nothing today is actually rooted in a trend that started way back at the dawn of civilization. So here's our roadmap. Our journey is going to start in the ancient world, a time when capital was super scarce and incredibly expensive. Then we'll hop over to medieval Venice and watch the birth of the very first public markets. From there, we'll uncover the stunning centuries-long decline in returns, see how stocks fit into the picture, and finally piece it all together to understand what it means for us in our modern low-return world. Okay, so let's kick things off at the very beginning of civilization. The need for capital, money to start a business, plant crops, or launch a trading voyage. That's as old as writing itself. And in the beginning, because capital was so scarce, it was also unbelievably expensive. I mean, just look at these numbers. They're wild. Anthropological data suggests that in prehistoric societies, if you lend out a pig or a sack of rice, you could expect a 100% return in a year. Can you imagine? By the time of ancient Mesopotamia, laws like the Code of Hammurabi actually had to step in to cap interest rates, but they were still sky high, 33% for grain, 20% for silver. It wasn't until the peak of the Roman Empire, which was a much wealthier, much more stable society, that rates finally fell to a more familiar 4%. You starting to see the pattern here? And this, right here, reveals the core idea of our entire journey today. The richer a society gets, the more capital it builds up. And just like with any other resource, when it becomes more abundant, its price, in this case the interest rate, has to fall. Think of it this way. Wealth and lower returns are really just two sides of the very same coin. All right, let's fast forward a bit to the 12th century, to the bustling, incredible trading hub of Venice. It's here that we see the next major step in our story, the birth of the first public market, where the value of an investment was no longer just some private deal, but a public spectacle for everyone to see.
So the Venetians invented this thing called the prestitiis. And what it was, basically, it was the government forcing its wealthy citizens to lend it money. In return, they got a steady 5% payment every year, forever. Now, critically, you could sell your right to get these payments to someone else. And just like that, the world's first widely traded government security was born.
Now, because the Venetians kept meticulous records, and thank goodness they did, this chart gives us this remarkable window into the past. It shows the price of prestity over 200 years, and as you can see, it is not a stable line. It is a volatile, emotional roller coaster that directly mirrors the fears and the fortunes of the Venetian Republic.
And this right here brilliantly shows the link between risk and price. In 1379, Venice's arch-rival, Genoa, literally sailed into the Venetian lagoon and blockaded the city. I mean, it looked like Venice was done for, and the market, it panicked. The price of prestity absolutely collapsed to just 19 cents on the dollar. But if you were brave enough to buy then, you would have more than doubled your money when Venice staged a pretty daring comeback.
This piece of history really teaches a timeless lesson, one that echoes from 14th century Venice all the way to the market crash of 2009. The greatest potential returns often show up when things look their absolute worst. But, it's a high-stakes game. Betting on a comeback can mean losing everything.
All that volatility in Venice, in the grand scheme of things, it was just noise. Behind it, a much larger, slower, and way more powerful trend was at work. We're now getting to the absolute heart of our story, the unstoppable 7th-century decline in the cost of capital.
Okay, take a really good look at this chart. This is probably the single most important visual for understanding our modern financial world. It plots the real risk-free interest rate, that's the return on the safest possible investment after you account for inflation, all the way from the year 1311 to today. Now, ignore the little short-term spikes. The overall direction is a clear, undeniable 700-year march downwards, from rates as high as 17% in the Middle Ages to basically zero in our time. And to put a number on it, this epic decline has averaged about 2 percentage points per century. It's a slow glacial force, but it's one that has completely reshaped our entire economic landscape. The days of high real yields on safe assets, they aren't just temporarily gone. They were the historical anomaly. Today's low rates are just the logical conclusion of a very, very long story.
So, what's behind this massive decline? Well, it pretty much boils down to 3 fundamental shifts in the human condition,
all pushing returns in the same downward direction. We've gotten a lot wealthier, we live a lot longer, and investing has become dramatically easier. First up, wealth. Thanks to centuries of technological innovation, we live in a world that is just overflowing with capital. The former Fed chairman Ben Bernanke even called this a savings glut. There's simply more saved money looking for productive investments than there are investments that need the money. It's basic supply and demand, right? When the supply of something, in this case capital, goes way up, its price, the interest rate, has to come down. Second, we live longer. The economist Irving Fisher talked about this idea of impatience. In the past, with short, often brutal lives, people were highly impatient. They wanted to consume things now. So you'd have to offer them a really high return to convince them to save for a future they might not even see. Today, we expect to live for decades in retirement. We have to save. And that creates this mountain of retirement funds that just further pushes down returns. And the third reason is just the sheer ease of investing today. Think about it. An ancient Mesopotamian capitalist had to physically go out and find someone to lend their silver to. That's a difficult, costly process that demanded a high return. Today, you can buy a diversified portfolio of the entire planet's stocks and bonds in about a minute for almost no cost. That convenience makes securities more valuable, which drives their prices up, and you guessed it, their future expected returns down. Now, we've mostly been talking about debt and interest rates. But what about stocks? I know you're wondering, does this same long-term decline apply to the equity markets? Well, the history of stocks kind of runs on a parallel track. While the hard data is a lot more recent, the underlying forces are exactly the same. Since 1900, stocks have typically offered about a 4 to 5% return premium over safer bonds to compensate for their higher risk. But as our world has gotten wealthier and less risky, and as investing has become easier, investors have been willing to pay more for those future earnings. This has pushed stock valuations up, and just like with bonds, it suggests that the future premium for holding stocks will probably be lower than it was in the past. And this brings us full circle, right back to our modern world of low returns. We've seen how centuries of increasing wealth, longer lives, and greater efficiency have all conspired to push them down. So the real question now is, should we actually see this as a problem? I think we have to look at the trade-off here. I mean, let's be honest. Would you really want the 20% return of a Mesopotamian capitalist if it meant living in a world of marauders, disease, and starvation? Those high returns were really just compensation for living in a dangerous, miserable, and capital-starved world. Our low returns today are a direct consequence of living in a safer, healthier, and vastly wealthier one. So while it can be frustrating to look at your portfolio's returns, it really is worth taking a more philosophical view. The very same forces that have driven down your investment returns have also banished famine, cured diseases, and given us a level of safety and prosperity that was just unimaginable to almost every human who has ever lived. And that's the final thought I want to leave you with. We can't have one without the other. Low returns aren't some bug in our modern system. They are a fundamental feature of its success. So the question for all of us then is a simple one. Is that a price worth paying? I'll let you decide. Thanks for joining us on The Explainer. So, what if I told you that the entire blueprint for the dot-com bust back in the 2000s was actually written in 1841, and that the script for that 19th century mania was basically penned way back in the 1700s? I know, it sounds kind of crazy, but this destructive pattern of speculative bubbles, it just repeats itself with such shocking regularity. It's almost like history has a script it just can't stop following. So today, let's dive headfirst into this incredible history of financial madness. You know, Harry Truman absolutely nailed it. Maybe the most powerful force in all of investing is just amnesia. See, back in 1841, a Scottish journalist named Charles Mackay published this book, Extraordinary Popular Delusions and the Madness of Crowds. It detailed these wild manias from centuries earlier. Well, fast forward to the late 1990s, and all of a sudden, Mackay's book becomes this surprise bestseller among investors who were just trying to make sense of the dot-com bubble. And the parallels, they were uncanny. I mean, the same hype, the same irrational exuberance, and, yup, the same disastrous ending. It was as if history was repeating itself note for note. All right, so buckle up as we take a bit of a wild ride through the history of financial madness. We're going to start by digging up some of the earliest and, frankly, most bizarre bubbles. Then, we'll dissect the anatomy of a mania, revealing the secret recipe that turns totally rational investors into, well, a ravenous herd. We'll even put that recipe to the test against some of the most epic speculative blowups in history. After that, we'll peer into the dark corners of the human psyche to really understand why we're so easily seduced by the siren song of a bubble. And finally, we'll arm you with a bubble spotting toolkit to help you navigate the treacherous waters of the market.
So, our story begins in a time before the internet, before electricity, heck, even before the United States of America. But even way back then, you better believe investors were finding incredibly creative ways to lose their shirts.
The year is 1687. Imagine this. A salty New England sea dog named William Phips sails into London, his ship literally groaning under the weight of 32 tons of Spanish silver. He'd salvaged it from a sunken galleon, and just like that, overnight, he and his investors were fabulously, outrageously rich. Well, that news sent a jolt of electricity through the city. Treasure, just sitting on the bottom of the sea waiting to be claimed. Entrepreneurs rushed to patent all sorts of diving engines, promising access to countless sunken fortunes. And just like that, a bubble was born.
But here's the thing, this bubble wasn't built on technology. It was built on a story. Phipps's success was the spark for sure, but the companies that popped up after were all smoke and mirrors. They had no real tech, no revenue, no credible plan to find, let alone salvage, any treasure. It was just pure unadulterated hype. And one of the people who fell for it? None other than Daniel Defoe, the author of Robinson Crusoe. His inside knowledge as a company treasurer didn't save him one bit. He went down with the ship, so to speak, in one of the biggest personal bankruptcies of the entire era.
Okay, so the diving bubble wasn't a fluke. From the 17th century on, these manias became a regular, really painful feature of financial life. So why then? What changed in the 1600s that suddenly turned the market into a casino? Turns out it was two things. First, the invention of modern credit. In London, goldsmiths started acting kind of like banks. They'd store gold for merchants and give them paper receipts. Pretty soon, these receipts started circulating as money. Then the goldsmiths had this light bulb moment. Hey, people rarely come to get their gold all at once. We can issue more receipts than we actually have gold. And just like that, they could create money out of thin air and loan it out at interest. This, right here, is the fuel for every single bubble. It's the rocket fuel that launches prices into the stratosphere. Now, the second ingredient is the spark. The 17th century was the dawn of the scientific revolution, and it just unleashed this torrent of innovation that's still flowing today. The economist Hyman Minsky had a name for this: displacement. It's some dazzling new invention or financial gadget that just completely captures the public's imagination. Think about the railroad, the radio, the internet, or even those crazy, complex financial products that brought the world to its knees in 2008. These are the powerful stories that bubbles are built on.
So there you have it, the 4-part recipe for a financial bubble. First, you need low interest rates to provide the fuel. Second, a compelling new technology to provide the story. Third, a whole new generation of investors who have no memory of the last crash. And finally, a complete and total abandonment of common sense when it comes to valuation. Mix them all together, and you've got yourself a recipe for disaster.
All right, so we've got our recipe. Now let's see if it actually works. We're going to apply it to some of the most legendary bubbles in history. The year 1720. Man, that was a vintage year for financial insanity. We had not one, but two massive parallel bubbles happening in France and England at the same time. In France, this financial wizard named John Law cooked up the Mississippi Company. The secret sauce? He let people swap their government bonds for company shares. And as the stock price soared, the company, which, by the way, was also a bank, just printed more money to buy its own shares, pushing the price even higher. The craze was so intense they literally had to invent a new word for the newly rich: millionaire. That madness quickly spread across the English Channel, where the South Sea Company ran the exact same play. Its shares went to the moon right before both bubbles imploded in a spectacular fireball of financial destruction. And it wasn't just the gullible and the greedy who got sucked in. Even Sir Isaac Newton, the guy who discovered gravity, couldn't resist the pull of the South Sea bubble. He invested early, sold for a tidy profit, but then, consumed by the fear of missing out as he watched his friends get even richer, he jumped back in near the top and lost an absolute fortune. His famous lament says it all: "I can calculate the motion of heavenly bodies, but not the madness of the people." Okay, let's fast forward to the 1840s and the British railway mania. The railroad was basically the internet of its day, a truly game-changing technology that just shrank the world. The public was completely obsessed, and at the exact same time, interest rates on safe government bonds were at rock bottom. As the journalist Walter Bagehot famously put it, the average British investor, John Bull, simply could not stomach earning a measly 2%. So what did they do? They piled into the exciting, high-return world of railway stocks. So, did the railway mania fit our four-part recipe? Oh, like a glove. The innovation, the world-changing railroad. Check. Easy credit? You bet. Low interest rates plus the ability to buy stocks on subscription with just a small down payment? Check. Amnesia? It had been over a century since the South Sea bubble. Those painful lessons were long forgotten. Check. And a complete abandonment of valuation? Absolutely. Promoters were planning rail lines from nowhere to nowhere with no hope of ever turning a profit. It was the perfect storm. Check.
Okay, so we've talked about the mechanics of bubbles, the fuel, the spark, all that. But what about the human element? I mean, why are we so damn susceptible to these collective delusions time and time again? The answer, well, it lies not in our wallets, but deep inside our heads.
This is really the million-dollar question, isn't it? It's not just about money and markets. It's about our evolutionary wiring. What is it about us, about Homo sapiens, that makes us such suckers for a good old-fashioned speculative mania? Well, it really boils down to two things. First, we are copycats. For millennia, our survival literally depended on our ability to imitate others. You know, if Oog the caveman figured out how to make a better spear, you copied him. It was a good survival strategy. But in the market, it's a recipe for disaster. When we see our neggers getting rich, our instinct isn't to ask questions, it's to do exactly what they're doing. And second, we're storytellers. We are just wired for narrative. A good story about some revolutionary new technology will always be more persuasive to us than a boring old spreadsheet, and that makes us incredibly vulnerable to the hype that fuels every single bubble.
All right, let's get practical. Now that we know how bubbles are made and why we fall for them, can we actually develop a toolkit to help us spot one out in the wild? You know, economists kind of hate the word bubble because you can't really define it with a neat formula. But that doesn't mean it isn't real. It's like what U.S. Supreme Court Justice Potter Stewart once said when he was asked to define something else entirely. He said, "I know it when I see it." And the same is true of bubbles. You might not be able to model them, but their social characteristics are unmistakable. So what are the telltale signs of a bubble in its final frothy phase? Well, history gives us 4 big red flags. First, the market becomes the only thing anyone talks about. You can't escape it. It's at dinner parties, in the back of a cab, it's everywhere. Second, people start quitting their day jobs to become full-time traders. Suddenly, your dentist, your barista, your dog walker, they're all market gurus. Third, if you dare to express even a shred of doubt, you're not met with a reasoned argument. You're met with a torrent of abuse. And finally, the predictions just become completely unhinged. People start talking about prices going to the moon, to Mars, to another galaxy entirely. This quote, it perfectly captures that third red flag, the hostility towards anyone who dares to question the narrative. During the dot-com bubble, if you pointed out that a company had no revenue and no profits, you weren't engaging in a debate. Oh no, you were simply told with this smug look of pity, you just don't get it. That phrase is the ultimate warning sign that you're in a bubble. It's the sound of faith drowning out reason.
So, okay, when you see these signs, you should just sell everything, right? You should time the market? No, absolutely not. Trying to time the market is a sucker's game. For one thing, most big run-ups are not bubbles that crash, they're just strong bull markets. If you sell every single time you see a bit of froth, you are going to miss out on a lot of gains. The smart, the sensible, the prudent move is to simply ignore the noise. Stick to your long-term diversified plan. Don't try to be a hero.
And that really brings us to our final and maybe most important point. We can't cure ourselves of this madness. It's baked into who we are. As Hyman Minsky so brilliantly observed, long periods of stability and prosperity, they make us careless. We take on more risk, which inevitably leads to instability and a crash. The fear from that crash then makes us cautious again, leading back to stability. It's an endless cycle, this perpetual dance between greed and fear that has been playing out for centuries, and it will continue to play out for as long as we have markets. The best we can do is to be aware of the dance and try like hell not to get swept away by the music.
Let's talk about something really tough. Let's talk about what actually happens in our heads during a market crash. For most people, it's just pure gut-wrenching panic. But for a very small group of people, it's something completely different. It's a historic opportunity.
This right here, this quote, it just gets to the heart of the emotional roller coaster, doesn't it? That's the voice of FOMO, the fear of missing out. And that feeling can be just as powerful, if not more powerful, than the fear of actually losing money. The woman who said this, Lucy White,
Well, her story is basically a perfect example of what happens when market timing goes horribly wrong. So picture this. It's 2008. The financial crisis is in full swing. Lucy and her husband feel, in their words, sucker punched. They watch their portfolio get cut in half. So they do what feels natural. They sell everything. They get out and they swear off stocks for good. But then by 2013, after 5 years of watching the market just roar back, they couldn't take it anymore. They jumped back in. They sold at the bottom and bought way, way up.
You know what's fascinating is that there's actually a technical name for what Lucy and her husband went through. It's called the dollar-time weighted gap. It's basically the gap between what a fund says it returned and what you actually earned because you got scared and jumped in and out at exactly the wrong times. And for the average investor, this gap cost them about 1.5% every single year.
And that costly gap, well, it brings us right to the core of what we're talking about today, this inescapable, emotionally driven trap of buying high and selling low. It's a pattern that has almost nothing to do with logic and everything to do with human psychology. So this is the million-dollar question, isn't it? I mean, think about it. The stocks that Lucy White and millions of other people were desperately selling in 2008, they didn't just disappear into thin air. Somebody had to be buying them. Someone was on the other side of that trade, calmly scooping up all those assets at a massive discount. So, who are they? Well, here are your prime suspects. We are talking about huge, disciplined pools of money. You've got hedge funds, university endowments like Harvard's or Yale's, the super rich, and even the companies themselves, who are using the opportunity to buy back their own stock on the cheap. These are the players who have a plan and, just as importantly, have the cash to actually use that plan when everyone else is running for the exits.
And look, this dynamic, this dance between panic and opportunity, it isn't new. This isn't a 2008 thing. This story is as old as markets themselves. Let's just take a quick trip back in time.
Just look at this chart. This is the South Sea bubble from way back in the 1720s. It was one of the first and still one of the most famous market frenzies in history. You see that massive euphoric spike up and then the catastrophic collapse? That pattern right there is basically the blueprint for almost every single boom and bust we've seen since.
Right after that bubble burst, the famous poet Alexander Pope wrote this, and his words just perfectly capture that universal feeling of shock that comes with every crash. Everybody thinks the party's gonna last forever. Nobody is ever really ready when the music stops. It always feels like it comes out of nowhere, like a thief in the night.
Okay, now let's fast forward 200 years to 1929. Winston Churchill, yes, that Winston Churchill, was actually visiting New York and happened to be in the gallery of the stock exchange during the crash. And what he saw was so strange, he said he was expecting to see total chaos, pandemonium. But instead, he saw this eerie, quiet calm, as people's fortunes were just systematically wiped out.
And my gosh, the speed was just terrifying. You had Black Thursday, then Black Monday, then Black Tuesday, just this relentless waterfall of selling. But here's the really crucial part. The actual bottom, the point of maximum pain, didn't come for almost 3 more years. Not until the Dow had fallen an agonizing 89%.
Now, here's something that messes with a lot of people's heads. This chart shows a really counterintuitive fact about bear markets. They are not just a straight line down. In fact, bear markets are defined by extreme volatility in both directions. Those days with huge price spikes to the upside, they happen almost as often as the huge drops. These are those vicious bear market rallies that suck people in, give them false hope, and then just chew them up.
So all that chaos, all that volatility, it brings us right back to our central question. Who are these people with the iron stomach to step into that kind of mess? What is it that truly separates them from everyone else?
There's this legendary quote, usually credited to J.P. Morgan, that just says it all. The idea here is that a market crash is really just a great reshuffling. It's a massive transfer of assets, from the panicked short-term tourists to the patient, long-term, rightful owners. So, the real question is, how do you become one of them? The secret, if there is one, comes down to this concept, unimpaired capital. Now, this isn't just about having money. It's about having safe, liquid money, cash, treasuries, that is completely separate from the money you need to live your life. It's capital you can afford to put to work without fear. And the psychological return you get from having that cash on hand, it's enormous. It's what allows you to think clearly when everyone else is freaking out. And this slide just lays it out perfectly. The difference in mindset is just night and day, isn't it? The panic seller is running on pure emotion, following the herd right off a cliff. But the patient buyer, they're running on discipline. They have a plan, and they use that unimpaired capital to seize the opportunity that everyone else's fear has created for them.
Okay, so this all sounds great on paper, right? Just have a plan, have some cash, be brave. Easy. But in the real world, in the heat of the moment, it is incredibly difficult to do. And the reason why is that our own brains put up these huge roadblocks to stop us from acting rationally.
There are three big traps. First, we're hardwired for empathy and imitation. We feel the crowd's fear, and our instinct is to run with them. Second, there's what some call the rat hole problem. When you start buying into a falling market, you're pretty much guaranteed to lose money at first. You buy some, it drops more. You buy more, it drops again. Every single purchase makes you feel like an idiot. And finally, there are the stories. At every single market bottom, the narratives in the news are absolutely terrifying. It's always the end of the world, the next Great Depression, a crisis with no end in sight.
If you want a perfect example of how powerful these narratives are, just look at this quote. This is from a legendary cover story in Businessweek back in 1979, right at the bottom of a nasty decade-long bear market. The smart money, the consensus view, was that stocks were dead, and only clueless old people were foolish enough to still own them.
But here's the punchline. Those so-called elderly investors, they weren't out of touch. They were the only ones with enough experience to ignore the scary stories. They had seen bear markets before. They knew how to do the basic math and could see that stocks were, historically speaking, just dirt cheap. They were the rightful owners.
So, how can you prepare to be one of those patient buyers? How can you get ready for the next time the sky starts falling? Let's boil everything we've talked about down into a simple survival kit.
It really just comes down to these three things. First, patience. The understanding that historically, markets do recover. Second, cash. That unimpaired capital that gives you the ability to act. And finally, the hardest one of all, courage. The raw fortitude to actually pull the trigger and execute your plan when every part of your brain is screaming, don't do it.
I absolutely love this quote. It totally reframes why you hold things like cash. It's not just a boring asset earning a low return. In a crisis, that cash transforms. It becomes a concentrate of courage. It's what empowers you to be rational when the world goes mad.
And really, that's the ultimate question to leave you with. Market panics aren't an if, they're a when. We know another one is coming eventually. The only real question is, when that day comes, will you have done the prep work? Will you have your own concentrate of courage ready to go? Why is it that when it comes to money, we are so often our own worst enemy? You know, the legendary investor Benjamin Graham absolutely nailed it. He said, the investor's chief problem, and even his worst enemy, is likely to be himself. So today, we're going to peel back the layers of our own minds. We're going to understand the psychological glitches, this ancient programming that makes us our own worst financial enemies. All right, let's jump in.
Now, I know what you're thinking. That sounds completely nuts, right? It's like a flight instructor telling a student pilot, when you're on a short runway and see trees ahead, to actually push the plane's nose down toward the trees. Why? To gain the speed you need to climb. And that's really the core of what we're talking about today, learning to replace our gut instincts with more effective and, yeah, often totally counterintuitive learned responses.
So here's our game plan. First, we're going to meet the two competing systems inside your brain. Then, we'll uncover the really dangerous mental shortcuts they love to take. We'll explore why we fall for a good story over cold, hard data, see how easily we get spooked, and finally, we'll tackle the massive trap of overconfidence. Let's get to it.
Okay, to really understand our investment misbehavior, we've got to understand the battlefield first. And that battlefield is our own brain. Just like Graham said, the problem isn't the market, it's the person staring back from the mirror. And lucky for us, modern neuroscience gives us a fantastic map of this internal conflict.
Think of your brain as running two different operating systems. You've got System 1, that's the ancient, fast, emotional reptile brain. It's where fear and greed live. Then you've got System 2, the modern, slow, analytical brain. So what's the problem? Well, the fast and furious reptile brain, System 1, it always acts first. System 2, the smart one, just comes in afterward. But not to correct System 1, no, it acts more like its press agent, cooking up a perfectly logical reason for the emotional decision we've already made.
Let's face it, the world is overwhelmingly complex.
To deal with it all, our brains create these little mental shortcuts or heuristics. Now, for day-to-day survival, they're incredibly useful. But in the world of finance, oh, they can be disastrously expensive, leading us to just ignore all the complexity and make really bad snap judgments.
Okay, take representativeness. Let me give you a classic puzzle. Imagine a guy named Steve. He's shy, he's tidy, and he has a passion for detail. Now, is Steve more likely to be a librarian or a farmer? Almost everyone immediately says librarian, right? Because he fits the stereotype. But that ignores one giant fact. There are way more farmers in the world than librarians. Our brain just grabs onto the story, the description, and completely ignores the base rate statistics. And this is exactly how we get suckered into buying a stock because it looks like the next Amazon, even when the odds are stacked against it.
And then there's anchoring. You see this everywhere, like a suggested retail price that makes the sale price look like an amazing deal. That first number, the anchor, it frames your whole perception of value. In investing, this is so dangerous. Say you buy a stock at $100. That price becomes your anchor. If it drops to $60, you refuse to sell because you're anchored to the $100 you paid. Your decision is being held hostage by a totally irrelevant piece of information from the past.
But the big one, the most important and dangerous of all, is availability. Daniel Kahneman has this brilliant name for it, wissiati, which stands for what you see is all there is. We make huge judgments based only on the information that's easy to remember, especially stuff that just happened. It's why people rush out to buy earthquake insurance after an earthquake, not before. And this recency bias, believe me, it is absolutely everywhere in finance.
Just look at this chart. This is wissiati in action. In the middle of 2020, after literally 4 decades of falling interest rates, investors just couldn't imagine a world where rates would go up. What they saw, years and years of falling rates, was all there was. So what did they do? They reached for yield. They took on huge risks with longer-term bonds just to squeeze out a tiny little extra bit of return. They were completely blinded by the recent past, until, of course, the future suddenly and violently changed.
And here's another flavor of wissiati, the stationarity fallacy. That's just a fancy way of saying we assume what worked in the past is going to keep working forever. Take the famous Shiller-Cape ratio, a popular tool for market valuation. I mean, the pattern looks so simple, doesn't it? Buy when the line is low, sell when it's high. It seduces investors into thinking they found a foolproof map for the future.
And you can see why it's so tempting. When you plot that Cape ratio against future returns, you get this downward-sloping cloud. It really looks like there's a relationship there. But the trap is thinking this pattern is set in stone. What this really shows is how you might have made money in the past, not how you will make money in the future. The big takeaway here is that the market is not a fixed game. The rules are always subtly changing.
You know, our brains didn't evolve to read spreadsheets. They evolved to survive by telling stories. We are hardwired to crave narrative. So when a problem gets too complex or too mathematical, we just default back to storytelling mode. And this fools us into thinking we understand something, when really, we're just enjoying a good plot.
This is exactly why we want our investments to be entertaining. We want to be part of an exciting story. It's so much more fun to gamble on finding the next Netflix than it is to own a boring old company that makes tractors. But here's the kicker. Decades of research show that initial public offerings, IPOs, are on average terrible investments. They combine high risk with shockingly low returns.
So the most crucial thing you can do is learn to tell the difference between real investing and just pure entertainment. Real investing, like buying John Deere, is often kind of boring, and it's all about the numbers. Entertainment, like chasing a hot tech IPO, is all about the story. And as you can see here, the more entertaining that story is, the lower its future returns are probably going to be.
Deep inside your brain, you've got these 2 little walnut-sized things called your amygdalae. They're your fear sensors, and they were great at keeping our ancestors from getting eaten by saber-toothed tigers. But today, in our relatively safe modern world, they're just sending out constant false alarms, especially when the stock market starts to tank.
Okay, this experiment is just absolutely fascinating. Researchers set up a simple coin flip game, but the odds were stacked in the player's favor. The totally rational move was to bet every single time. And look at this. Normal people, guided by their emotions, only bet about half the time. But patients with damage to their emotional brain circuits, they behaved like cold calculating machines, betting 84% of the time. In this specific game, their lack of fear actually made them better investors. And this is exactly why fear has such a grip on us. Behavioral economists have found that the psychological pain of losing a dollar is about twice as powerful as the pleasure you get from gaining one. Now think about this. The market has almost as many down days as up days. So if you check your portfolio constantly, you are literally setting yourself up for continuous psychological pain. The market just can't clear this 2-to-1 hedonic hurdle on a daily basis. The practical lesson here? The more you look, the worse it's going to feel. And that is a powerful argument for just having a plan and sticking to it.
And now we arrive at maybe the most human of all our biases, overconfidence. It's like we're all residents of the fictional town of Lake Wobegon, where, as the story goes, all the children are above average. We just systematically overestimate our own abilities, our prospects, and our knowledge.
This old survey from 1998 just captures our collective delusion perfectly. Look at these numbers. Investors lowered their expectations for the market as a whole, but they still believed their own personal portfolio would beat that market. That is mathematically impossible. We can't all be above average. By definition, the average investor is the market, minus fees. But in our heads, we're all the exception.
And the most dangerous form of overconfidence is overestimating your own tolerance for risk. I mean, it is so easy to look at a chart like this and say, oh yeah, sure, I can handle a 25% loss to have 60% in stocks. But filling out a questionnaire is not the same as living through a real financial crisis when it feels like the world is literally ending. Our perceived tolerance for risk is almost always higher than our actual tolerance when the chips are down.
Overconfidence often goes hand in hand with another powerful human drive, seeking status. And in the investment world, nothing screams status quite like a hedge fund. Their exclusivity and their crazy high fees, the classic 2 and 20, made them the equivalent of a Birkin bag for your portfolio. The whole allure was getting into something that other people couldn't.
But what happens when everybody starts chasing the same status symbol? It loses its value. And that's exactly what happened here. As this chart shows, from 1998 to 2012, the amount of money in hedge funds exploded tenfold. All that money crowded into the same trades, and performance just cratered. Eventually, the average hedge fund couldn't even keep up with a simple, cheap mix of stocks and T-bills. Turns out, status is a terrible investment strategy.
So, after this whole tour of our flawed financial minds, we're left with this one inescapable conclusion, first voiced by the cartoon character Pogo. We have met the enemy, and he is us. We all like to think we're the cool, logical Mr. Spock, but in reality, we're probably all a little bit more like George Costanza.
This is our costly financial humanity in a nutshell. We are hostages to our emotional reptile brain. We take flawed mental shortcuts and fall for simple stories instead of hard facts. We look for entertainment and status in a game that rewards nothing but cold discipline. We are prisoners of the recent past, and we are chronically, dangerously overconfident about our own abilities and how much risk we can actually handle.
Just recognizing these flaws is the first and most critical step. So the final question isn't whether you have these biases. You do. We all do. The question is, now that you've been properly introduced to the enemy within, what's your plan to manage it? What's your strategy for the next battle?
All right, let's talk about the single biggest challenge in finance. And here's a hint. It has nothing to do with charts, algorithms, or the economy. Nope. The biggest battle is the one that happens right inside your own head. Today we're talking about how to deal with your inner Shakespeare.
And this quote right here, it just nails it. You can have a room full of Nobel Prize winners who have absolutely mastered the math, like the guys at Long-Term Capital Management, but if you can't get a handle on your own emotions, it's all for nothing. That's what we're digging into, this constant tug-of-war between logic and our own crazy, irrational human brains.
So, here's our battle plan for today. First, we're going to meet your inner Shakespeare. Then we'll figure out why we're so drawn to bad ideas. After that, we'll talk about training our inner Spock, the logical part of our brain, and give him the tools he needs to win. And finally, we'll map out what the path to sane investing actually looks like.
Okay, so what on earth is this inner Shakespeare? Well, think of it like this. Inside every single one of us, there's a character who just loves drama. He's emotional, he's impulsive, and he's totally driven by big, sweeping stories, especially tragedies. He's the part of you that gets swept up in the greed, panics during a crash, and basically does everything possible to wreck your financial future.
And what's wild is that this has zero to do with how smart you are. It's just human nature. We're basically storytelling apes.
Our brains are hardwired to respond to a good story, a compelling narrative, way more than a boring spreadsheet. And in the world of investing, that can be a fatal flaw.
So how does our inner Shakespeare actually pull this off? How does he trick us? Well, he's got a whole arsenal of cognitive biases. These little mental shortcuts our brain uses that feel right, but almost always lead us in the wrong direction. It's a war, and it's being fought entirely inside our own heads.
And one of Shakespeare's most powerful weapons is this little thing called YSIATI. It stands for What You See Is All There Is. It means our brain takes whatever's happening right now, a terrifying headline, a market plunge, and blows it up, making it feel like it's the only thing that matters. We totally forget the long-term picture. This is the voice in your head that screams, "Get out, sell everything," right at the absolute bottom of a crash.
You want to see Wizziati in action? Just look at the history of junk bonds. Think about these moments of pure, unadulterated panic. The S&L crisis, the 2008 meltdown, the start of the COVID pandemic. In every case, junk bonds just got obliterated. The story everyone was telling was that these things were toxic waste. And yet, looking back, these moments of maximum pessimism were the absolute best times to buy.
And here's the math behind why that is. See, in normal, boring times, the extra reward you get for taking the risk of owning junk bonds is, well, it's pretty tiny. You might get about 5% more in yield than safe government bonds, but historically, about 4% of that gets wiped out by companies going bankrupt. So your net gain is a measly 1%. For all that risk, it's barely worth it. But look what happens when the panic really kicks in. During the 2008 crisis, that extra reward for being brave, the spread, shot up to almost 20%. All of a sudden, the math completely flips on its head. The potential reward for buying when everyone else is terrified becomes absolutely massive. This is the moment when your rational brain has to step in and overpower that primal fear.
The legendary investor John Templeton just said it perfectly. The whole game is completely counterintuitive. It demands that you do the exact opposite of what your emotions are telling you. You have to buy when you feel physically sick about the market, and you have to be really, really careful when everyone around you is giddy and euphoric.
So, if we need to be scared of euphoria, what are the red flags? Well, here are some of the alarm bells that our inner Shakespeare absolutely loves. A compelling story, a slick guru on TV, a super charismatic CEO like Adam Newman from WeWork. These are all giant warning signs. Anytime you hear someone say it's a new era or they confuse a really cool company with a good investment, your alarm bell should be ringing. Your brain wants the story, not the data.
Okay, so if Shakespeare's the villain in this story, who's the hero? Well, allow me to introduce your inner Spock. This is the logical, slow, deliberate, data-driven part of your brain. He's the one who can look past all the drama and just focus on the facts. He's the guy we need to put in charge.
And the contrast between these two is just night and day. Psychologists call them System 1 and System 2. So when the market is crashing, your System 1, your Shakespeare, is just running around screaming, "The sky is falling, sell everything now!" But your System 2, your Spock, if you give him a chance to speak, just calmly looks at the data and says, "This is illogical. Prices are lower. That simply means that my expected returns in the future are now higher."
And this is so important. You are never, ever going to silence Shakespeare. You can't. You're a human being. That pit in your stomach you feel when your portfolio is down 20%, that's real. But the goal is to train your inner Spock to hear that signal not as a command to panic sell, but as just another piece of data. A data point that says, it appears we have reached a time of maximum pessimism. Historically, this is a good sign.
So how do we actually do this? How do we get Spock into the captain's chair? Well, we've got to give him the right tools for the job. So let's go through the 5 key items in a rational investor's toolkit.
Okay, here they are. Rule number 1. Make it mundane. Your investing strategy should be boring. If you're getting entertainment out of it, trust me, you're paying a very high price for that entertainment. 2. Relish the random. You have to accept that trying to find patterns in day-to-day market moves is a total illusion. 3. Get your risks straight. The real enemy isn't a 20% drop. It's inflation slowly eating away at your money over 30 years. 4. Don't become a whale. Stay away from those fancy, exclusive, high-fee products. They're designed to make someone else rich, not you. And finally, number 5, stay humble. The market is smarter than you. Don't let a few lucky wins go to your head.
You know, to really drive home that point about focusing on the long term, just listen to this incredible observation from Benjamin Graham. He noticed that people who owned these obscure bonds that didn't have a price quoted every single day were less likely to panic. Why? Because they weren't constantly reminded of their paper losses. They just held on and did great. The lesson for us is simple. Stop checking your portfolio so much. Seriously, out of sight, out of trouble.
A really practical way to empower your inner Spock is to build yourself a security blanket with safe assets. Think cash, government bonds, that kind of thing. This is what gives you the mental fortitude to ignore the short-term craziness. How much you need depends on you, right? But for someone who's just retired, having 5, maybe even 10 years of living expenses locked down in safe stuff means you can sleep at night no matter what the stock market is doing.
Okay, let's tie this all together now. When you really get down to it, sane investing isn't about picking better stocks. It's about adopting a whole different philosophy. It's about completely redefining what winning even means. And it really comes down to this one fundamental choice. What is your goal? Is it to maximize your chances of getting rich, or is it to minimize your chances of dying poor? See, the first goal sends you chasing lottery tickets, hot IPOs, meme stocks, the whole circus. The second, more rational goal leads you to a dull, boring, low-cost, and passive approach that is, by far, the most reliable way to build real wealth.
So, one last warning. You have to be aware of the Carney Barkers out there. There is a massive industry, from financial media to brokerage firms, whose entire business model is built on appealing to your inner Shakespeare. They need you to be emotional, excited, and scared. They need you to act, because every time you buy or sell, they get paid. One of the best financial decisions you can ever make is to just ignore them.
And we'll leave you with this one question to think about. A truly effective portfolio should be deadly dull. It should be about as exciting as watching paint dry. So take an honest look at what you're doing with your money and ask yourself, is it entertaining you? Because if the answer is yes, you might be paying way too much for the show.
You know, we're all kind of taught to think of our financial advisor as this trusted partner, someone who's always got our back. But what if that's not the whole story? What if the system they operate in is actually designed to put their interests way ahead of yours? Well, today, we're going to pull back that curtain. We're going to see how the financial services industry really works, and why your broker might not be your buddy after all. So here's our game plan. First, we're taking a little trip to a very strange place called Chernovia. It'll make the core problem crystal clear. Then, we'll look at a noble dream that was completely betrayed, and we'll break down the modern broker's playbook piece by piece. After that, we'll figure out how to spot a whale, build up your defensive strategy, and finally, we'll wade through the murky waters of the insurance swamp.
All right, to really get what we're talking about, I need you to use your imagination for a second. Just picture this. You're working overseas in this fictional country called Chernovia. And look, the culture's amazing, the food's incredible, but the legal system, well, let's just say it's a little shaky. Then, one day, out of nowhere, you're hit with this sudden, sharp pain in your stomach. It's excruciating. You're rushed to the hospital, and they immediately wheel you away for what they assure you is just a routine emergency appendectomy. You get through it, you recover, you go home, and everything seems to be fine. But then, your spouse notices something really weird. When you're sleeping, there's this faint sound coming from your stomach. You go into a quiet room to check it out, and yep, there it is, a soft, regular ticking. So you go back and confront your surgeon, and his reaction is just so casual it's chilling. He just shrugs and says, "Oh yes, it's not unusual for bellies to tick after appendicitis." At this point, your faith in Chernovian medicine is completely shattered. You get on the first flight home, where your own doctors find the horrifying truth. That surgeon in Chernovia, he left his wristwatch inside of you. And now, it's surrounded by infected tissue. This isn't just a mistake. It is a profound, unbelievable betrayal of trust. This whole crazy, nightmarish story, it's not just some weird tale. It is a perfect metaphor for the U.S. brokerage industry. So, welcome to Chernovia. This story really gets to the heart of the problem, and it all boils down to one fundamental, crucial distinction. See, on one side, you have what's called a fiduciary duty. This is the absolute highest legal standard there is. It means someone, like your doctor or your lawyer, is legally required to always act in your best interest, period. But on the other side is what most brokers operate under, a much, much weaker suitability standard. Now, they recently tried to rebrand it as Regulation Best Interest, or Reg BI, but don't let the name fool you. It still allows for massive conflicts of interest. The advice they give doesn't have to be the best for you, it just has to be suitable.
That's a huge difference. So just how bad is this problem? Well, check this out. A Harvard study sent actors out with these perfect, low-cost index fund portfolios to a bunch of different brokers. And the result? Only 2.4% of them, let that sink in, 2.4%, resisted the temptation to tell the client to sell that perfectly good portfolio and switch into high-fee products that would make the broker a fat commission. The system's incentives are just that powerful.
So how is this even possible? Why is the system so broken? It really comes down to three things. First, the licensing is a joke. In a lot of states, it's literally harder to become a manicurist. You just have to pass a multiple choice test. Second, like we just talked about, there's no real fiduciary duty. And third, if you ever have a dispute, you're forced into an arbitration system that's run by the industry's own regulatory body. Talk about a stacked deck. But here's the crazy thing. It wasn't always supposed to be this way.
To understand how we ended up here, you've got to know the story of a guy who had this revolutionary vision for Wall Street, Charlie Merrill. He was absolutely disgusted by the corruption of the 1920s, and he set out to build a new kind of firm, one the public could actually, finally trust.
So back in 1939, he started his firm with a simple, but at the time, totally radical idea. Pay brokers a salary, not commissions. This one simple change removed the incentive to just churn client accounts for fees. And for decades, it worked. His employees were objective stewards of their clients' money. But then, in 1968, a guy named Donald Regan took over. The market was roaring, and brokers at other firms were getting filthy rich on commissions. Merrill's salaried folks started leaving. And by 1971, Reagan completely caved. He brought back commissions, and just like that, Merrill's original vision was dead. He turned clients right back into cash cows.
In that betrayal, well, it paved the way for the modern brokerage industry. So let's crack open the modern broker's playbook and see exactly how they turn your money into their profit. Okay, this is really important. You've got to understand how the trades themselves are structured. In what's called an agency transaction, your broker is just a middleman, and they take a commission. Pretty straightforward. But in a principal transaction, the firm is actually selling you an investment from its own inventory. They might even tell you it's commission-free, but they're making money on what's called the spread. That's the hidden markup between what they paid for it and what you're paying. And trust me, that hidden cost can be substantial. The financial writer Fred Schwed just perfectly summed up the whole industry with this amazing, cynical quote. It brilliantly captures that fundamental conflict of interest. The whole system is designed to make sure the house gets paid first, and you, the client, just get whatever's left over. And this conflict of interest, it seeps into everything, even the so-called research you get. Analysts at big firms are under enormous pressure to slap a buy rating on any company their firm does business with. I mean, look at the dot-com bubble. That pressure was so intense that seller ratings basically vanished. They dropped to just 1%. It just goes to show, you, the regular investor, are always the last one to get the memo when it's time to get out. But, as people got wise to the old commission game, the industry had to get smarter. They adapted. The new model isn't so much about churning trades anymore, it's about selling complexity. Now, advisors will charge you a big annual fee, maybe 1 or 2% of everything you've got, to manage this dizzying portfolio of dozens of overlapping funds. All that complexity is there to justify their fee, but it rarely, if ever, actually improves your returns. Now, this playbook gets used on pretty much everyone, but there is one specific group that gets targeted with the most expensive, most complicated products out there: high net worth investors. And in the industry, they've got a special name for you. Yeah, they call you a whale. And listen, don't be flattered. It is not a VIP term. It means you have a giant target on your back. You're the one they're going to pitch all the exclusive investments to, these super complex products like hedge funds and private equity, which more often than not are just incredibly clever vehicles designed to bleed you dry with layers and layers of hidden fees. Okay, I know. This all sounds pretty bleak. We've gone through the problems, the playbook. It can feel a little overwhelming. But here's the good news. You can absolutely protect yourself. It all comes down to a really simple but incredibly powerful defensive strategy. Because it really all boils down to this one simple question, right? With all these hidden motives, all these conflicts of interest floating around, how in the world can you find an advisor you can actually genuinely trust? All right, here they are, the 4 rules that will keep you safe. You should probably write these down. Number 1, avoid advisors who are constantly pushing actively managed funds. Simplicity is your best friend. Number 2, just say no to so-called alternative investments like hedge funds. They are almost always designed to make the manager rich, not you. 3, Watch the fees like a hawk. Anything even approaching 1% of your assets every year is a massive red flag. And number 4, this is the big one, the non-negotiable. Demand that they sign a fiduciary oath in writing. If they hesitate, if they give you any pushback at all, you have your answer. You run. There is one more minefield we have to navigate, and it is a doozy. It's that murky place where investing and insurance get all mixed together, and it creates some of the most complicated, highest-cost products on the planet. Welcome to the insurance swamp. One of the most common products you'll see pushed is the fixed index annuity. They pitch it as all the upside of the stock market with none of the risk. And it sounds way too good to be true because, well, it is. The nasty truth is always buried deep in the fine print. So the next time a salesperson tries to pitch you one of these, I want you to be armed with these 6 simple questions. What's the cap on my return? Can you lower that cap later? Does the return I get exclude dividends? Just asking these simple, direct questions will completely dismantle their sales pitch and show you what the product really is. And that really brings us full circle to the one essential question you have to leave here with. Your advisor is paid to give you advice. That's their job. But now you have the tools to ask the most important question of all. Is that advice truly designed to benefit your portfolio, or is it designed to benefit theirs? The answer to that question, well, it changes absolutely everything. Welcome to The Explainer. Today, we are going to talk about the evolution of mutual funds. And you know, it's a wild story. It's got dangerous traps, a fired manager's brilliant revenge, and honestly, a revolution that completely changed how we all invest, forever. So think about it. Are your investments actually designed to make you rich or someone else? I mean, that question gets right to the heart of this huge, long-standing problem in the investment world. It's a conflict of interest that honestly plagued investors for decades. That is, until one guy decided to just completely rewrite the rules of the game. All right, here's what we're going to cover. First, we'll look at the old days, a real playground of dangers for investors. Then, we'll get into this thing called hot money. After that, the Bogle Revolution. This is where things get really interesting. We'll see how that led to the triumph of the index fund. Then, we'll touch on ETFs, which are kind of a double-edged sword. And finally, we'll wrap it all up with what this means for you. So, for a huge chunk of the 20th century, if you were just an average person trying to invest, the mutual fund world was, well, it was a total minefield. Seriously. And while there were a bunch of dangers, the first and most common trap you'd run into was something called a sales load. So what is a sales load? It's really just a fancy term for a commission paid to a broker for selling you a fund. And they got real creative with these. You could have a front-end load where they'd skim, get this, up to 9% right off the top of your investment before it even got to work. Or back-end load when you tried to sell, or even ongoing fees. But here's the kicker, the bottom line. This fee gave you absolutely zero benefit. None. It just made someone else richer, plain and simple, at your expense. Okay, so those fees were bad enough, right? But in the 1980s, an even bigger danger started to pop up. Something way more seductive and, as it turns out, way more destructive. The chase for what the industry insiders call hot money. And it all kicks off with this one fund. It posted an absolutely blistering track record. I mean, look at that number, 162% return in just 12 months. That's almost unbelievable, right? And of course, it immediately got a ton of media attention. Yeah, a major magazine ran this as a cover story. Hype machine in full effect, calling it a sure thing. They even had the fund's young manager pose for a photo, in shorts, holding a squash racket in the middle of a freezing cold Boston winter. I'm not making that up. The hype was just completely, totally off the charts. And of course, the public absolutely ate it up. In 1983, investors just poured money in, tripling the fund-sized $650 million in just a few weeks. But, wouldn't you know it, almost immediately after all that hype, the tech market just collapsed. It created this incredibly painful boom and bust cycle for everyone who bought in. Look at this timeline. By '89, the fund's assets had cratered to just $71 million. But then, history repeats itself. During the dot-com mania in '99, it happened all over again. Assets swelled to over $5 billion right before the crash in 2000. It caught a whole new generation of investors at the absolute worst possible time. And this right here is the truly shocking result of all that hype. So get this. While the fund itself actually did okay over its entire life, a study found that the average person who invested in it earned 13.4% less per year. How is that even possible? Well, it's because they were chasing performance. They were buying high after reading all the magazine articles and then selling low in a total panic.
And there's a name for this whole phenomenon: hot money. It perfectly illustrates that core conflict of interest we talked about at the very beginning. See, fund companies exist to gather assets. That's their business model, right? That's how they make their money, from fees. They don't necessarily exist to make you money.
But just when it seemed like this broken system was just the way things were, a revolution was sparked. And it came from a really unlikely source: a recently fired, quote-unquote, hotshot money manager named John Bogle. You probably know him as Jack. So Jack Bogle had just been fired after a risky merger he championed completely blew up. But sometimes failure gives you clarity. In that moment, he saw the fundamental problem with the entire industry. And it was a problem that the economist Paul Samuelson summed up perfectly with this quote: Bogle realized investors were playing a rigged game. They were on the wrong side of the bar. So what did he do? He reached back to his college thesis, which gave him this deep, almost encyclopedic knowledge of how the industry was regulated. And he used it to engineer something totally new, totally radical. He asked a simple but brilliant question that would end up changing everything.
And the answer to that question was Vanguard, the first and still the only truly mutual fund company. It's kind of genius how it works. The funds themselves are owned by their shareholders, right? But then the management company, Vanguard, is owned by the funds. So what does that mean? It means the shareholders actually own Vanguard. This brilliantly simple move completely wiped out that conflict of interest. Vanguard had zero incentive to milk its customers for fees because its customers were its owners.
But Bogle wasn't even close to being done. His next big idea, well, it would become an absolutely unstoppable force that pretty much nobody in the industry saw coming. So, in 1976, Bogle launches the very first index fund for regular people. And the idea was just beautifully simple. Instead of paying some manager a fortune to try and fail to beat the market, this fund would just aim to match the market's return and do it at the lowest possible cost. And you know what? The rest of the industry, they just laughed at him. They called it Bogle's folly.
Yeah, his biggest rivals were openly dismissive. The chairman of Fidelity, Ned Johnson, delivered this zinger. He just couldn't believe that anyone would be satisfied with being average. He thought everyone wanted the thrill of the chase, trying to be the best. Well, let's just say he was dead wrong.
Because simple math just took over. Remember that mutual structure Bogle created? Well, it meant that as the index fund got more and more assets, its costs dropped. And what do lower costs mean? Better performance, especially when you compare it to all those expensive, actively managed funds. And that better performance attracted, well, you guessed it, even more assets. It was this perfect self-reinforcing loop, a virtuous cycle. And this chart just brilliantly illustrates what happened next. What started out as this kind of slow-motion avalanche eventually just completely reshaped the entire investment landscape. I mean, just look at the explosive growth of indexed assets compared to the basically flatlining of money in those old active funds. This is how Bogle's folly became an undeniable triumph. But, Bogle's revolution didn't stop with the good old-fashioned mutual fund. The next step in this evolution was the rise of exchange-traded funds, or ETFs. Now, these are basically index funds that you can trade all day long, just like a stock. And they bring some fantastic new advantages to the table, but as you'll see, also some brand new risks. Yeah, the trade-off here with ETFs is really fascinating. So on one hand, they're often even cheaper and more tax efficient than the mutual funds they're based on. Awesome, right? But on the other hand, you can see the danger. The very thing that makes them easy to use, the fact that you can trade them all day long, can encourage that same exact bad behavior, that hot money chasing that Jack Bogle wanted to get rid of in the first place. It's no wonder Bogle himself famously said that creating ETFs was like handing a match to an arsonist. All right, so we've taken this whole journey, right, from a dangerous playground full of fees and hype all the way to a much more investor-friendly world. So, what does all this mean for you? How should you approach your own investing strategy now? Well, the biggest lessons from this entire revolution are actually beautifully simple. First, stick to low-cost index funds or ETFs. Just keep your costs rock bottom. Second, never, ever forget this. Performance comes and goes, but expenses are forever. And third, If you are going to use ETFs, just trade them carefully, use limit orders, and maybe try to avoid trading right at the market open or close to avoid any weird price swings. Look, the Bogle Revolution was, without a doubt, an incredible victory. It empowered millions of regular people. But it's also led to a brand new reality. It's something Jack Bogle himself worried about before he passed away. With just 3 giant companies now controlling about half of the entire U.S. stock market, who really has the power now? It raises these new, really important questions about corporate governance and what the future of investing is going to look like.
You know the feeling. You see the headlines, and that little knot of anxiety starts to form in your stomach. Well, today, we're going to pull back the curtain on the force that drives all of that. We're going to put a name to it: investment pornography. And trust me, understanding what this is could completely change how you think about your money.
It always starts with a feeling, doesn't it? You just scrolling through your feed and bam, a quote like this pops up from some influencer. I'm scared to death of stocks right now. And it just hits a nerve, you know? It feels so relatable, so emotional, and it's just the opening act.
And then, right on cue, the big media outlets jump in. You click over to a financial news site, and a headline from some big-shot columnist is practically yelling at you, "There's no place to hide in this market." All of a sudden, that personal fear feels universal. It's like all the doors are being locked at once.
And then, just to really seal the deal, you get the expert confirmation. Some economist comes on and says something that sounds kind of technical, but is really just terrifying, like a lot more air is coming out of the market's tires. Now it doesn't just feel bad, it sounds official. It sounds real.
That whole cycle, does it sound familiar? That constant feeling of crisis, the breathless headlines, that nagging, urgent voice in the back of your head telling you that you've got to do something with your money, like right now before it's all gone.
Okay, so here's the thing. Every single one of those quotes, they're completely fake. They were all written for a satirical article specifically to mimic the kind of financial journalism we see every single day. The names are even jokes, borrowed from Charles Dickens' novels. The reason it feels so real is because we've been trained to recognize this script. It plays out constantly.
So if this script is basically on a loop everywhere we look, what exactly is it? It's time to put a proper name to the phenomenon. It's time for a diagnosis.
And that name is financial pornography. The term was coined by the brilliant personal finance writer Jane Bryant Quinn. And what it describes is all this investment coverage that isn't really there to inform you, it's there to excite you. It sells you on these fantasies that you can time the market perfectly, that you can pick the next Amazon, that you can get rich quick if you just follow the right guru.
Quinn herself just nailed it when she said this. It's investment pornography. Softcore, not hardcore, but pornography all the same. It is such a powerful metaphor because this content is designed to do one thing: trigger an emotional reaction, a desire for immediate action, not to give you the sober, actually useful advice you need.
So what are the telltale signs? Well, you'll see these really broad claims about market fear or greed. You'll read these dramatic, almost soap opera-like stories about regular people getting wiped out or striking it rich. You'll see prediction after prediction from experts who, if you actually check, have a terrible track record. And there's always a fixation on a celebrity manager, like Cathie Wood. And of course, you know them, you've seen them, those irresistible headlines. Top 10 funds to buy now.
Okay, so this has to make you wonder, right? If this stuff is so unhelpful, why in the world is it absolutely everywhere? Well, the answer has everything to do with the media's real business model.
See, it's a really simple but powerful loop. First, media companies need to fill airtime and web pages 24/7. Second, what gets the most eyeballs? Sensational, emotional, urgent stories. Third, those clicks and high ratings let them charge more for advertising. And fourth, this is the kicker, who's the biggest advertiser of all? The financial services industry. The very same people selling the products being hyped. And get this, an anonymous reporter for Fortune magazine once admitted that by day, they'd write these 6 funds to buy now articles, but at night, they personally invested in boring, sensible index funds. Why the hypocrisy? They spelled it out. Rational, sensible advice just doesn't sell. The sound financial advice that we actually need just isn't exciting enough to drive their business.
So we know why this stuff exists, but what's the actual real-world damage to your wallet? To really get that, you have to understand the difference between entertainment and actual information.
The source material for this explainer uses a perfect analogy. Financial media gives us cotton candy when what we really need is spinach. Think about it.
Cotton candy is a sugar rush. It's emotional. It's all about the short-term thrill, and it makes you want more right away. Spinach? Well, it's what actually nourishes you. It's analytical, it's about the long term, and it requires patience. The media serves us what we crave, not what's good for our financial health. But let's just ask the big question. Maybe the cotton candy is secretly good for us. I mean, does listening to these TV experts and jumping on their hot tips actually work? Does it make you more money?
Well, thankfully, researchers looked into this exact question, and the data is pretty shocking. This chart right here tracks stocks that get hyped up on CNBC. See that huge spike right around day 0? That's the day the stock gets mentioned on TV. The hype is real. But look what happens right after.
Almost immediately, the stock starts to underperform, consistently. Here's what that actually means in the real world. That TV segment isn't a signal to buy. It's a signal that the party's over. By the time a regular person like you or me hears the tip, we're the absolute last to arrive. We're buying at the very peak, likely from insiders who are happily cashing out.
Okay, so if the mainstream financial media is the disease, then what's the cure? We need to talk about the antidote. And it all comes down to building a much better, healthier information diet for yourself.
Honestly, the best place to start is to just turn off the TV and pick up a book. And these aren't get-rich-quick guides. They're foundational texts about investing theory, history, and psychology. Reading a book like Bogle's Common Sense on Mutual Funds or Zweig's Your Money in Your Brain, it's like building a mental firewall that makes you immune to all the daily hype.
And for your ongoing information, you just have to be more selective. It's about making a conscious swap. So instead of the shouting matches on cable news, try thoughtful podcasts like Masters in Business. Instead of chasing breaking news headlines, read the deep, nuanced analysis you'll find in places like The Economist or The Financial Times.
And when you're online, believe it or not, there are oases of sanity. Websites like bogleheads.org have amazing forums and educational resources that are all about long-term success. HumbleDollar.com has some of the clearest, smartest writing out there. And if you just need to understand a financial term without any spin, Investopedia is your go-to.
At the end of the day, it all comes down to this one simple question. I want you to really think about it. Take a hard look at the articles you're reading, the shows you're watching, the accounts you're following, and ask yourself, is your financial media diet designed to build your wealth, or is it designed to build theirs? The answer, well, it might just change everything.
Welcome to The Explainer. You know, there's this one question that hangs over almost everyone's head. How much do I actually need to retire? It's a huge question, right? It can cause a ton of stress. But stick with me because by the end of this, you're going to have a much clearer and, frankly, more realistic way to think about it.
So, what do we do when we have this giant question? Well, a lot of us go online and find one of those retirement calculators. You punch in your numbers, click a button, and boom, out pops a very specific, very official-looking number. And for a second, you feel this sense of relief, of certainty. But here's the thing. That certainty is probably a lie. And look, that's not just me being a downer. This quote you're seeing, it's straight from our source material. That's how they describe the accuracy of these calculators. So today, we're going to pull back the curtain and see why these tools are so misleading, and more importantly, what you should be doing instead.
All right, so let's just tear this whole idea of a perfect, precise retirement number apart, shall we? The basic problem is that trying to predict your financial life 40 years from now is, well, it's basically like trying to predict the weather 40 years from now. It's built on pure guesswork.
I mean, just think about it for a second. These calculators act like the future is going to be a nice, straight line. They have no way of knowing about a market crash or you changing careers or a sudden illness. And a really big flaw is that they often look at the amazing stock market returns from the last few decades and just assume that's going to happen forever. Newsflash, it probably won't. It all just lulls you into this false sense of security with a number that's basically science fiction.
And that's the big question, isn't it? If precision is a total myth, then what are we supposed to do? Just throw our hands up? No. The answer is to stop chasing that one perfect, magical number. The real goal is just to get yourself into the right ballpark. It's about building a plan that's flexible and strong, not one that's fragile and based on a fantasy.
Okay, so how do we find that ballpark? Well, it starts with a beautifully simple but really powerful rule of thumb, and it's called the 25-year rule.
Here's the breakdown. It's just 4 simple steps. That's it. First, you got to figure out roughly what you'll spend in a year once you're retired. Second, you subtract any income you know you're getting, like Social Security. The number you're left with, that's your residual living expenses, or RLE for short. And finally, you take that RLE number and multiply it by 25. That's your target. Now, this RLE number, this is the number. This is the one you really need to tattoo on your brain, because that's the amount of money your personal savings have to generate for you year in and year out. It's the gap you are personally responsible for filling. Okay, that's a lot of theory. Let's make this real. Our source gives us a great example. Let's meet Fritz. He's 65, he just retired, and he's running the numbers. All right, so Fritz has done his homework. He figures he needs about 50 grand a year to live comfortably. Step 1, done. But, and this is a big but, he doesn't have to pull all 50,000 of that out of his own savings. See, Fritz knows he's going to get about $20,000 a year combined from Social Security and a small pension. That's guaranteed money. So you take his $50,000 in expenses, you subtract that $20,000, and what are you left with? $30,000. That's his RLE. That's the gap his investments have to fill every single year. And now for the final step, the magic number. We take that $30,000 RLE and we multiply it by 25, and boom, we get $750,000. That's Fritz's ballpark retirement goal. That's the nest egg he needs to make his plan work. Simple, right? Well, Fritz had it kind of easy. The world's changed a lot since he started saving. This is where things get really, really interesting, because the playbook that worked for Fritz, who benefited from decades of just incredible returns in the market, that playbook is pretty much useless for someone who's just starting their career today. The path is so much steeper. So let's meet his niece, Felicia. She's 25, and her goal is exactly the same as her uncle's. Save up $750,000 in today's money. But she's staring down a future where everyone expects investment returns to be way, way lower than what Fritz enjoyed. And honestly, our source puts it perfectly with this classic line. Because for Felicia, the amount she needs to save every month isn't a sure thing. It's a total gamble on what kind of returns the finance gods are going to give her over the next 40 years. Just look at this table. This lays out the whole problem in black and white. It's a huge range of possibilities. If Felicia gets super lucky and earns a 6% return after inflation, she only needs to sock away about $377 a month. Totally doable. But now, slide your finger over to the left. If she only gets a 2% real return, that number explodes to over $1,000 a month. That's almost triple. A small change in returns makes a massive difference in her effort. And it's not just about returns, it's about time. Time is your absolute superpower here. Look at this. Let's say we assume a pretty reasonable 4% return. If Felicia gets going at 25, she has to save about 10% of her salary. Okay, tough but manageable. But if she waits just 10 years, just to age 35, that savings rate nearly doubles to 18.5%. That's just brutal. The price you pay for waiting is astronomical. So what do you do with all this uncertainty about the future? You can't control the stock market, right? You focus with laser-like intensity on the one variable you have almost total control over, your savings rate, how much you save. You know, the source brings up this amazing finding from the book The Millionaire Next Door. It found that, on average, plumbers retire earlier than lawyers. And you're thinking, how on earth is that possible? Lawyers make way more money. Well, it's simple. The lawyer often has to spend a lot more on the fancy car, the big house, the whole lifestyle. Their savings rate is lower. The plumber, with lower expenses, can save a much bigger chunk of their paycheck. It all boils down to this, and this is maybe the most important lesson in personal finance. It is not about how big your paycheck is. It's about how big the gap is between what you earn and what you spend. Frugality, not making a ton of money, is the real engine of wealth. And this whole mindset, focusing on what you can control, on your savings, it goes way beyond just retirement. It's really the foundation for your entire financial life, for every major goal you're ever going to have. The big idea here is that you can't use the same strategy for every single goal. For short-term stuff like a down payment on a house you want to buy in 3 years, that money has to be safe. You can't risk it in the stock market. But for really long-term goals like retirement 40 years away, you can and should take on more risk for higher growth. You've got to match the right tool to the right job. Okay, so let's bring it all home. What did we learn today? First, just forget about those precise retirement calculators. They're a fantasy. Instead, focus on a simple, robust goal, saving 25 times your RLE. Use that easy calculation to get in the right ballpark. And most importantly, remember that your savings rate is the most powerful weapon you have in your financial arsenal. In the end, it all comes down to this one question. Are you building a plan for a perfect, predictable future that will never happen? Or are you preparing for the messy, unpredictable, and exciting reality of life? Because building a plan that can withstand a few surprises, well, that's a plan that's actually going to work.
All right, let's dive in. Today, we're going to look at your investment portfolio as a whole life cycle. I mean, from the very beginning to the very end. We're going to talk about the strategy for building your wealth, the discipline you need to maintain it when things get rocky, and finally, the game plan for actually spending it.
So this is really the big question, isn't it? Every single investor has to face this. You're saving up for a future that is, well, completely unpredictable. Who knows what the next 10 years will bring? Massive inflation? A huge market boom? Something nobody even sees coming? How in the world do you prepare for that?
Well, the best way to think about it is with an analogy. Picture your portfolio like a house you're building. Now, you wouldn't build that house to only handle a little bit of rain just because that's what's in the forecast for tomorrow, right? Of course not. You build it to survive hurricanes, fires, floods, you name it. Your portfolio needs to be built with that exact same all-weather, survive-anything mindset.
So here's the roadmap for our journey today. First, we'll lay out the blueprint, the core philosophy for a portfolio that can take a punch. Then, we'll check out 3 really different ways people build their wealth. After that, we'll get into the long game of maintenance, tackle the tricky problem of investing a sudden windfall, and finally, we'll break down how you make that money last once you retire.
Okay, first things first. Let's talk about the foundation. The most important thing to get here is that winning at investing isn't about making these brilliant, once-in-a-lifetime stock picks. No, it's about something much, much simpler. It's about winning by not making huge mistakes.
Author Charles Ellis came up with this fantastic analogy. He says investing is a lot like amateur tennis. See, at your local tennis club, people don't win matches by hitting incredible acrobatic shots. They win because they just keep hitting the ball back over the net, and eventually their opponent messes up. They make an unforced error. For an investor, those errors are things like chasing hot trends or putting all your eggs in one basket. The winning move is just to keep the ball in play with a really diversified portfolio.
Okay, so we've got our blueprint. Now it's time to actually start building. We're going to look at this phase by meeting 3 different types of investors. And as we go through them, I want you to ask yourself, which one of these sounds the most like me?
Okay, so first up, we've got Yvonne. She's a creative professional, and look, finance just isn't her thing. And that's totally fine. She just wants a simple, solid plan that she can set up once and pretty much forget about. For her, the less tinkering, the better.
For someone like Yvonne, a target date fund is the perfect solution. But here's the really clever part of her strategy. She's young, so conventional wisdom might say she should be in a super aggressive fund. But she's never actually lived through a nasty bear market. So the biggest risk for her isn't that she'll have low returns, it's that she'll panic and sell everything at the worst possible time. By starting with a more conservative fund, she gets to test her own emotional tolerance for a downturn. If she handles it well, hey, she can always dial up the risk later. The #1 goal is just to stay in the game.
All right, next up is Yvette. She's comfortable with numbers. In fact, she works with them all day. She wants to be more directly involved in managing her money. She wants to understand all the pieces and have control over how they're put together.
So Yvette goes for a classic 60% stock, 40% bond portfolio, but she builds it herself using a handful of broad index funds. You can see she's got a big chunk in the US market, but she's also diversifying with international and emerging market stocks. Now, the real key to her whole plan is rebalancing. Every couple of years, she's going to sell a little bit of what's done well and buy a little bit of what hasn't to get back to these original percentages. Yeah, it's more work, but for her, that control is everything.
And finally, we have Yolanda. She's a software developer, she's fantastic with math, and she actually finds financial theory fascinating. She's the kind of person who enjoys complexity and has the discipline to pull off a much more advanced strategy.
Yolanda uses a technique called value averaging. Now, this is a bit different from just investing, say, $500 a month. Instead, she sets a target value she wants her portfolio to hit each quarter. So for example, maybe her goal is to have $10,000 by the end of March. If the market tanks and her account is only worth $8,000, she has to kick in $2,000 to hit her target. But if the market soars and it's worth $11,000, guess what? She might not invest a single penny.
It's an incredibly disciplined way to force yourself to buy more when things are cheap.
Okay, I know this table looks like a lot, but don't get bogged down in the details. Just look at that first column, quarter, and the second one, USDSM. You can see her target amount for US stocks grows steadily each quarter. The amount she actually invests is just whatever it takes to close the gap between what she has and what her target is. This method basically rolls her regular contributions and her rebalancing all into one move. It's complex, sure, but it's also really powerful.
All right, now we move into the long middle part of the journey. You've built your portfolio. For the next few decades, the goal is just to maintain it. And this is where the real work begins. It's all about one thing: discipline. Specifically, the discipline to rebalance.
So why is rebalancing such a big deal? Well, it comes down to a fundamental trade-off. If you just let your portfolio ride, your stocks are almost guaranteed to grow faster than your bonds. Over time, a portfolio you started at 50-50 could drift until it's basically a 99% stock portfolio. And while that might give you a higher return on paper, your risk level has just gone through the roof. Rebalancing is just the simple act of trimming those winners to keep your risk exactly where you want it.
But it's about more than just managing risk. It's psychological weight training for an investor. It forces you systematically to sell what's popular and expensive and buy what's unloved and cheap. It's a workout for your financial discipline, and it builds the exact kind of mindset Warren Buffett is talking about here. It's the mechanism that trains you to go against the herd.
All right, let's switch gears and talk about a pretty unique problem. Most of us invest a little bit at a time from our paychecks, but what happens if you suddenly get a huge chunk of cash all at once, maybe from an inheritance or you sell a business? How do you handle that?
So let's imagine a guy named Ted. He just sold his company and is now sitting on a pile of cash with a lot of zeros. He's already done his homework. He knows exactly the portfolio he wants to build. The problem isn't the what. The million-dollar question is when. Does he dump it all into the market tomorrow, or does he ease in slowly?
A really popular strategy here is called dollar cost averaging, or DCA. Let's just walk through a super simple example to see why it feels so good. You invest the same amount of money, let's say $30, at different price points. When the stock is cheap at $5, your $30 buys you 6 shares. When it's expensive at $15, you only get 2 shares. Your average cost per share ends up being $8.18, which is way better than the average price of $10. It feels like a can't-lose strategy.
Okay, but here's the twist. The math shows that about 2/3 of the time you'd actually make more money by investing the lump sum all at once, just because the market tends to go up over time. But this whole decision, it's not a math problem. It's a regret problem. Think of it like a financial insurance policy. DCA protects you from the absolute worst-case scenario for your psyche, putting your entire life savings into the market the day before it crashes 50%. It might be the wrong choice mathematically, but it could be the absolute right choice for your own peace of mind.
So we've built it, we've maintained it, and now we've reached the final chapter, spending it. And it turns out, how you take money out of your portfolio in retirement is every bit as important as how you put it in.
For any retiree, there is one number that matters more than anything else. It's called your burn rate. It's simply the percentage of your total portfolio you need to pull out each year to live on. And believe me, this one number dictates pretty much every other decision you have to make, especially how much risk you can afford to take.
And to see just how much this matters, let's look at 2 guys, Fritz and Frank. Fritz has a pretty high burn rate, about 4%. For him, a couple of bad years in the stock market right when he retires could be devastating. His number one priority has to be protecting his original investment. But now look at Frank. His burn rate is a tiny 1%. He's not even really managing the money for himself at this point. He's managing it for his kids. He can afford to stay 100% in stocks because the dividends alone could probably cover his expenses. Their strategies couldn't be more different, and it all comes down to that one number.
After all this talk about different portfolios and fancy strategies and all these numbers, it all really comes down to this one question. You can have the most perfect, mathematically sound portfolio on the planet, but it's completely worthless if you can't stick with it when the pressure is on. So the real question isn't about what's in your portfolio, it's about you. When the market gets crazy, and it will, can you stick to your plan? That's the ultimate test.
Hey, so if you've ever looked at the world of investing and just felt completely overwhelmed by all the choices, you are definitely not alone. What we're going to do today is break down the nuts and bolts of building your own portfolio, from your 401k all the way to your personal brokerage account. We're going to make it simple and actionable. So let's dive in. This quote, it just perfectly captures the massive shift that's happened in retirement planning over the last few decades.
I mean, think about it. You walk onto a plane, and instead of showing you to your seat, the flight attendant points you toward the cockpit. That's pretty much what's happened with our financial futures.
See, for a long, long time, our parents' or grandparents' generation, many of them had pensions. These defined benefit plans where the company did all the work. But that world is mostly gone. Companies have moved to defined contribution plans, and the most famous of these is, of course, the 401k. And this wasn't just some small tweak in paperwork. And that, right there, is the single most important thing to understand. The job of making sure you have enough money for retirement, of saving it, investing it the right way, and making sure it lasts, that job now belongs to you. It means you need to know what you're doing. You need a flight plan, because you're the pilot now.
All right, let's talk about the 401k. I know, it gets a bad rap sometimes, but honestly, it has gone through this massive transformation. It's kind of like the most improved player of the whole retirement game. It is a much, much better tool for you today than it was even a couple of decades ago. I mean, you have to understand just how bad things were. Back in the bad old days, 401ks were often a nightmare. We're talking about fees that could eat up 2% or more of your money every single year, plus hidden fees, a lousy selection of expensive funds. It was a system that often made a lot of money for everyone but the employee. So, how did we get out of that mess? Well, you can pretty much thank 3 people for it. First, John Bogle, the father of the low-cost index fund. Then you have Richard Thaler, whose work in behavioral economics made simple, effective target date funds the default choice for so many people. And then there's this guy, Jerome Schlichter, a lawyer who basically terrified corporate America into doing the right thing. And get this, his work was so impactful that people actually coined a new word for it. Schlichterized. It literally means the fear a company has of getting sued for offering a terrible, high-fee 401k. This guy basically forced companies to clean up their act and take their duty to their employees seriously. Okay, so what if you're stuck in one of those crummy plans? What do you do? It's actually a really simple game plan. Step 1. No matter what, you contribute enough to get the full employer match. That's free money. Don't leave it on the table. Step 2, any money you save beyond the match, you put that into your own personal low-cost IRA. And step 3, the second you leave that job, you roll all that 401k money over into your IRA and get away from those high fees for good. All right, so that's your 401k. Now let's talk about your personal accounts, your IRAs, your taxable accounts. This is where you have total control. You're not just the pilot anymore. Now you get to pick the exact aircraft you want to fly. And the great news is, thanks to some really intense competition, you've got some amazing low-cost choices. For what felt like forever, Vanguard was the only game in town for super low-cost investing. But then, something amazing happened, something people call the Vanguard effect. Competitors like Fidelity and Schwab realized they had to drop their prices to even stay in the game. And the result of that war? It's a huge win for us. Rock-bottom index fund fees and commission-free ETF trading are now just standard. So the million-dollar question, Vanguard, Fidelity, or Schwab, which one's for you? Well, look, each one has its good and its bad. Vanguard has this amazing investor-first culture, but yeah, their customer service has seen better days. Fidelity has a super easy-to-use website and even some zero-fee funds, but you have to be careful not to get tempted by their expensive stuff. And Schwab has fantastic customer support, but you gotta watch out for their cash sweep account. There's no perfect answer, you just have to pick the one whose trade-offs you can live with. Okay, now listen up, because this is where you can save yourself a lot of headache and money. There are little traps you need to watch out for. At Fidelity, they have these target date funds with almost the same name. You have to make sure you're buying the Freedom Index funds, not the pricey ones. At Schwab, any cash you have can't just sit in their default account. You have to actively move it into a money market fund to get a decent yield. And here's a rule for everywhere. Whenever you trade an ETF, always use a limit order. All right, so you've picked your aircraft. Now it's time to understand the controls on the dashboard. We're talking about the actual things you invest in. And for most people, that comes down to 2 main choices: exchange-traded funds, or ETFs, and the more traditional open-end mutual funds. I mean, the number of ETFs out there is just staggering. Look at this. Back in 2021, there were more than 8,500 of them. Just 10 years before that, there were less than 300. This explosion of choice is great in some ways, but wow, it can also be totally paralyzing. So what's the actual difference between these two? It really just boils down to one thing: timing. With a mutual fund, you put in your order, and at the end of the day, after the market closes, you get whatever that day's closing price was. Simple. But an ETF, that trades all day long, just like a stock. You can buy or sell it any second the market is open. So you have more control, but that also means you have more chances to make a mistake. Okay, when you see a table like this, it can look like a wall of numbers, right? Super intimidating. But I promise you, you only need to look at two things. First, the ticker. That's just the symbol you type into the search bar to buy it. And second, and this is the really important one, is the expense ratio. That's how much the fund costs you every year. And for a big, simple index fund, you want that number to be tiny, like almost zero. Okay, so once you've got the basics down, you've got your low-cost index funds, you might start hearing about these more advanced strategies. One of the most talked about is something called tilting. You can think of it as trying to pull off an advanced maneuver in your plane, hoping to get a little extra performance. But here is the thing about advanced maneuvers. They come with advanced risks. So you really, really have to ask yourself if the potential for a slightly better return is worth the very real psychological pain that can come along with it. So what the heck is tilting? Basically, instead of just buying the whole market in its exact proportions, you're making a deliberate bet. You tilt your portfolio by overweighting certain slices of the market that historically have delivered higher returns. The most common tilts are towards smaller companies, which we call small cap, and cheap, out-of-favor companies, which we call value stocks. And this is the critical trade-off you have to understand. On the one hand, the potential reward is, well, higher returns over the long run. But the risk? Oh man, the risk is huge. These factors can go through brutally long periods where they underperform the plain old market. The value factor, for example, has been in the doghouse for the better part of 20 years. If you're going to tilt, you need the stomach to stick with it when it's not working. And trust me, that is so much harder than it sounds. Okay, that's enough talk about taking risks. Let's switch gears and talk about the opposite, safety. This is about the other part of your portfolio, your bonds, or fixed income. This part has a totally different mission. Its job isn't to make you rich, its job is to make sure you have a safe landing. There's this saying that I just absolutely love because it nails it. Your stocks are for taking risks, your bonds are for letting you sleep. Your stocks are the engine. They're what's supposed to grow your money over time. But your bonds, they're the ballast. They're there to keep the ship steady when the stock market gets stormy. So how do you actually build that sleep at night part of your portfolio? Here are the rules to live by. First, focus on debt that has a government guarantee. We're talking CDs and treasury bonds. Second, be really careful with corporate or municipal bond funds. They can have issues in a real crisis. Treasury ETFs are generally okay because they're so easy to trade. And finally, for retirees, the absolute safest way to fund your expenses is with something called a TIPS ladder. Look, when you step back and see how far we've come, from the 401k revolution to the price wars between the big brokerages, the tools have never been better and the costs have never been lower. Everything you need to build a really great, low-cost portfolio is right there at your fingertips. Your financial flight plan, it's in your hands. So the only question left is, are you ready to grab the controls?
Forget fleeting stock tips and market noise. Today, we're building an investment fortress. Not with bricks and mortar, but with knowledge. We're going to dive deep into a strategy built on 4 unshakable pillars. Principles designed to withstand pretty much any market storm, all based on the book, The 4 Pillars of Investing.
So let me just ask you, straight up, is your investment strategy actually built to last? Or, if you're being honest, is it kind of built on shaky ground? You know, hot tips, what you hear on the news, that kind of thing. Well, today, we're going to give you the blueprint for a portfolio that's truly resilient.
All right, so here's our game plan. We're going to start with a really powerful metaphor called the unstable chair. Then we'll build our fortress, pillar by pillar. We've got theory, then history, then psychology, and finally, the business of investing. Stick with me, and by the end, you'll see a clear path to success.
So it all kicks off with a simple but really profound idea, the unstable chair. And this is the foundation for everything else we're going to talk about.
Okay, so check out this core analogy from the book. Think of your entire investment strategy like a 4-legged chair. It needs all 4 of those legs to be stable, right? Now take away just one. Doesn't matter which one. Theory, history, your own psychology, or the industry itself, and what happens? You're going down. All 4 of these are totally non-negotiable.
So, let's lay down our first pillar, the blueprint. Think of this as like the fundamental physics of the investing world. This is all about understanding investment theory.
The number one law in this universe is actually super simple. Risk and return are basically joined at the hip. You just cannot have one without the other. It's a package deal. If you're chasing those high returns, guess what? You've got to accept high risk. And if you crave safety, you have to be okay with low returns. There's just no magic way around this trade-off. And this just hammers the point home perfectly. The author is crystal clear here, saying, the promise of high returns with low risk is a reliable marker for fraud. So anytime you hear a pitch like that, your internal alarm bells should be going absolutely crazy. It's a total violation of the basic laws of finance.
Okay, so if we can't get high returns for free, maybe we can just outsmart everyone else, right? Well, the answer is a big, resounding no. The market is way smarter than any single one of us. So, the key takeaway here is this. Instead of wasting all your time and money trying to find that one winning needle in the giant market haystack, the smartest, most prudent thing to do is to just own the whole haystack. Diversify.
So we have our blueprint from theory, but now we need some context. And for that, we step into our time machine. Welcome to Pillar 2, Learning from Investment History. You know, they say history doesn't repeat itself, but it sure does rhyme. And market history follows this really familiar plot. First comes the hype. Some new tech is going to change the world. That leads to a bubble because everyone's terrified of missing out. And you know what comes next? The crash. It feels like the world is ending. But, and this is the most important part, that moment of pure terror, that is almost always the moment of maximum opportunity.
And that right there is the real power of knowing your history. When you're stuck in the middle of all that market madness, you can take a step back and think, wait a minute, I've seen this movie before. I know how this ends. That knowledge becomes your shield. It stops you from panicking and helps you make rational moves when everyone else is losing their minds.
All right, we've got the theory, we've got the history, but now it's time to face our toughest opponent. And that brings us to Pillar 3, the mirror, mastering investment psychology. This quote from Fred Schwed is just so powerful because it gets right to the heart of the gap between knowing something and feeling something. You can read about risk all day long, but he's saying nothing can truly prepare you for just how awful it feels to see your nest egg suddenly shrink. I mean, knowing you should be calm and actually feeling calm when your money is disappearing, yeah, those are two totally different worlds.
And the thing is, we're all just wired with these mental glitches that work against us. We get way too confident in our own genius. We fall for the herd instinct, buying stuff only after it's gotten popular and expensive. We start seeing patterns in random market charts that just aren't there. And maybe the biggest one of all, we completely underestimate how we're going to feel when the market really turns against us.
This all leads to a pretty stark but absolutely essential conclusion. To really succeed, you have to fight against that urge to follow the crowd. If you're invested in the same hot stocks as all your friends, you're probably too late. Successful investing isn't a team sport. It's a solitary game that requires you to think for yourself.
Okay, time for the final piece of the puzzle. We've mastered our inner world, but now we got to learn to navigate the outer world. This is Pillar 4, the minefield, navigating the investment business.
Wow. The author does not pull any punches here. He warns that a lot of brokers and advisors service their clients in the same way that Bonnie and Clyde serviced car dealerships. Look, it's a cynical take, for sure, but it's a memorable way to warn you about the huge conflicts of interest that often exist between you and the very people who are paid to help you.
So you might be asking, why is that? Well, it really helps to understand their business model. For a lot of these big fund companies, the main goal isn't actually to get the best returns for you. Nope. The primary business is just collecting assets. See, the more assets they manage, the more fees they collect. And that's true whether your portfolio does well or not. Their goals are not always your goals.
So where can we get good info? Well, according to this book, you should be really skeptical. This chart kind of sums up the author's view on your typical financial news, whether it's print or social media. 99% of it is worse than worthless. Think about it. It's mostly just noise designed to get you to click, to sell ads, not to make you a smarter investor.
And if you thought that was bad, just take a look at cable TV financial news. The author's take here is even more brutal, 100% worthless. He basically calls it a non-stop stream of hype about people who got temporarily lucky. It's designed for entertainment, not education. For a serious investor, it is a complete and total distraction. Okay, so we've made it through the minefield and we've put up our defenses. Now, let's bring it all home and look at your path to success by actually assembling this fortress.
And here it is, the whole framework in one place. Theory tells you that risk and return are inseparable. History shows you that the cycles of fear and greed are going to happen. Psychology warns you that you are hardwired to make mistakes during those cycles. And business teaches you how to deal with an industry that loves to prey on those very mistakes. You see, each pillar holds up the others.
But look, just knowing these 4 pillars, that's not enough. The legendary Jack Bogle said it best. The essential characteristics of the successful investor are the discipline and the stamina to stay the course. You can have the most perfect blueprint in the world, but it is totally useless if you don't have the discipline to actually follow it, especially when things get rocky.
And that, my friends, brings us to the final and most important question. We've given you the blueprint. You now know what it takes to build a successful investment strategy that can last a lifetime. The only question left is this one. Do you have the discipline?
Welcome to The Explainer. So today we're going to try something a little unusual. We are going to completely decode a classic investing book. But here's the catch. We're not going to read a single page of it. So how in the world are we going to do that? Well, instead of starting with chapter 1, we're going to dive straight into the book's, let's call it, intellectual DNA. We're talking about the thinkers, the theories, the big historical moments that it's built on. It's kind of like we're reverse engineering the whole argument. Yeah, think of us as intellectual detectives, right? We're piecing together the core message from all the clues left behind in the bibliography and the index. So let's get started. Our investigation kicks off with the very first big problem this book tries to tackle. And right away, our investigation leads us straight to the bedrock of this book's entire argument. And it's a powerful and, frankly, pretty humbling theory. The idea that the market is just brutally efficient. Okay, so the book's sources? They put a ton of weight on this one concept, the efficient market hypothesis. Now, the core idea here is a little bit of a mind bender, so stick with me. It basically says that the collective wisdom of millions of investors, all buying and selling at once, instantly bakes all available information into every single stock price. What does that mean for you? It means by the time you hear a hot tip from your buddy, it's way too late. The information's already in the price. As they say, there are no $20 bills just lying on the sidewalk waiting for you to pick them up. And when you look at the endnotes, it's like a who's who of financial giants. I mean, you've got Louis Bachelier, who noticed way back in 1900 that stock prices seem to move completely at random. Then there's Burton Malkiel, the random walk down Wall Street guy, and of course Eugene Fama, who really formalized this whole hypothesis. But the real bombshell came from William Sharpe. His research showed that even the pros, the super highly paid fund managers, they consistently fail to beat simple market averages. So this whole idea, it's built on a mountain of really serious academic work. So what's the big takeaway from all this research? It's this. Trying to outsmart the combined brain power of the entire market isn't just hard, it's pretty much a fool's errand. The odds of you or me or even a whole team of Wall Street geniuses consistently picking winning stocks are, let's be honest, vanishingly small. Okay, but wait a second. This brings up a really fascinating contradiction, right? If the market is this perfectly rational, super efficient machine, then how on earth do we explain its long, chaotic history of, well, complete and utter madness? And this, my friends, is where the plot really thickens. Because while all the academic sources are arguing for a rational market, the book's index tells a totally different story. It's a story that's been written over centuries, and it's full of irrational bubbles and absolutely devastating crashes. I mean, seriously, the index is like a graveyard of market manias. You've got the South Sea bubble in the 1720s, where people were literally trading shares in companies that had zero actual assets. Then there was the British railway mania in the 1840s, the Great Crash of 1929, obviously. And who could forget the dot-com bubble of the late 90s? When companies with absolutely no profits were being valued in the billions. This isn't rational behavior. It's a recurring cycle of mass euphoria followed by total panic. And just in case you're sitting there thinking, Piff, I'm too smart to get caught up in all that, well, the source notes have a truly humbling story for you. We're talking about Sir Isaac Newton. Yeah, that Isaac Newton, one of the greatest scientific minds in history. Even he got swept up in the South Sea bubble and lost an absolute fortune. His conclusion after all that? I can calculate the motion of heavenly bodies, but not the madness of people. That's a powerful, powerful reminder that being smart is absolutely no defense against the madness of crowds. So this brings us to the final piece of this problem puzzle. Let's recap. We've got a market that's brutally efficient, but it's also prone to these fits of madness. So if the problem isn't 100% with the market itself, where else do we look? Well, the book's sources point us inward. They suggest we need to look at the very wiring of our own brains. And this is where the references take a really dramatic turn. We pivot away from finance and history, and we dive headfirst into behavioral psychology. And the conclusion they reach is, well, it's pretty startling. It turns out the biggest risk to your long-term wealth isn't a market crash. Nope. It's the flawed, emotional, and predictably irrational brain you're using to make all your decisions. The book leans heavily on the groundbreaking work of Nobel winner Daniel Kahneman and his partner Amos Tversky. And what they do is they contrast this idea of a perfect, rational investor with the messy reality of how we actually behave. See, we think we're being logical, but really, we're just driven by fear and greed. We suffer from overconfidence bias, that feeling that we're all definitely above average drivers. And we're plagued by something called myopic loss aversion. Now, that's just a fancy way of saying that the pain of losing $100 feels way, way worse than the pleasure of gaining $100. And that emotional imbalance, it's a total recipe for disaster. It's what causes us to do the exact wrong thing, sell low and buy high. All right, so let's just step back and take stock of the problem here. We're up against a market that's a ruthless, nearly unbeatable machine. We're trying to navigate a history that's just littered with the landmines of emotional manias. And to top it all off, we're doing it with a brain that seems to be hardwired to make terrible financial choices. It sounds pretty hopeless, doesn't it? Well, here's the good news. It's not. The book's sources argue that the solution is actually hiding in plain sight. See, once you truly accept this trifecta of problems, the efficient market, the history of mania, and your own biased brain, the solution becomes surprisingly clear. It's got nothing to do with finding some secret stock-picking formula or a super complex new strategy. Nope. It's an approach that's built on a radical acceptance of our own limitations. It's about trading in your ego for a little humility, swapping complexity for simplicity, and replacing panic with discipline. And the hero of this whole story, the name that just keeps popping up again and again in the sources, is John Bogle. Bogle's genius was that he took all that heavy academic research seriously, and he created something truly revolutionary for the everyday investor, the index fund. His idea was so simple, yet so profound. He basically said, hey, if you can't beat the market, why not just own the market? And that's exactly what an index fund does. It just buys and holds all the stocks in a big, broad index, like the S&P 500.
So this whole philosophy, it really boils down to a beautifully simple 3-step game plan. Step 1, diversify broadly. Look, since you can't reliably pick the winners, the only logical move is to own them all. Step 2, keep your costs rock bottom. I mean, every single dollar you pay in fees is a dollar that's not growing and compounding for you. And step 3, and listen, this is by far the hardest part, you have to stay the course. That means tuning out the noise, ignoring all the hot tips from your friends, and just letting the strategy do its thing for decades. And the real quiet power of the strategy is how it just systematically dismantles every single problem we've talked about. It acknowledges that you can't beat the efficient market, so it doesn't even try. Its automated, do-nothing nature is the perfect antidote to our emotional, panic-driven brains. It harnesses the long-term growth of the entire economy instead of just betting on a few little pieces of it. And finally, it neutralizes the two biggest killers of your returns, trying to time the market and paying crazy high fees. But maybe the most powerful and honestly the most cynical piece of wisdom we found in the book's sources comes from a classic title from way back in 1940. It tells this great story about a wide-eyed visitor to New York. He's admiring all these magnificent yachts owned by the bankers and the brokers, and then he turns to his guide and he instantly asks, but where are the customers' yachts? It's such a great question, isn't it? It's timeless, it's cynical, and it cuts right to the heart of the matter. The book's ultimate message, the one we've pieced together from its intellectual DNA, is this. The path to building your own wealth, to buying your own yacht, so to speak, it isn't found in all of Wall Street's complex and super costly promises. No, it's found in a simple, sensible, and disciplined long-term plan that you, and only you, are in control of.